Top stories. Most US stocks fall as the continued First Republic turmoil deepens concerns about regional banks. But the Nasdaq and US futures climb on strong tech earnings, with Meta sales topping estimates post-market. Amazon reports today. Plus, Barclays revenue at its corporate investment bank tops estimates, fueled by strong fixed income trading. We speak exclusively to the CEO this hour. Let's check in on the futures then as we weigh up the picture. It's a tussle between concerns about recession risks in the US as we lead up to the GDP print versus, of course, what is happening across these earnings. And it is a resilient picture coming through from the European banks, the likes of Barclays, Deutsche Bank, but also consumer goods around Unilever, and then, of course, the component on tech. The future's pointing to lower, though, by about 0.1%. It is the banking turmoil, again, that's pushing back against the earnings narrative, and whether that's going to be a more sustained concern, a more sustained picture when it comes to tightened lending conditions, tightening credit conditions in the US. And if you add on to that a Fed hike, an expected Fed hike in May, the recession risks at the US. But earnings are front and center as well, and the details coming through from some of those corporates suggesting that there is still that resilience. The Spanish IBEX currently down 0.5%. Here in the UK, the FTSE 100 off by 0.3. The big story around Barclays, and of course the CEO interview coming on later this hour. Over in France, the CAC 40 off by 18 points. Let's flip it over then and see how things are playing out. You had a bit of a turnaround in terms of sentiment over in Asia. 4 straight days of losses. It was pointing lower, the main benchmark, MSCI Asia Pacific, but that has turned slightly more positive as we head to the close over in Asia. The futures in the US then pointing to upside on the Nasdaq futures of 0.8%. Meta coming through then with some very strong sales numbers in terms of advertising, digital ads. Here's the number though as well. The users of all of Meta's platforms, whether that's WhatsApp or Facebook, 3 billion now, 3 billion in a global population of 8 billion. It's pretty remarkable in terms of that headline coming through for Meta. Euro dollar at 110, further gains then of 0.1%. The 2-year at 3.96, yields just moving by 1 basis point. And Brent, $78 a barrel, that's a gain in session of 0.5%. But you've written off all of the gains still for oil since that surprise OPEC Plus cut earlier this month. Let's get back to the earnings picture then, and the win coming through from Unilever, beating sales growth expectations in the first quarter as consumer demand proved more resilient than expected in the face of price hikes. We spoke to CEO Alan Jope.
There is more inflation coming into our cost base, 1.5 billion incremental in the first half. So costs are not coming down. They're just not going up as quickly as they were.
Okay, we're going to bring you more of that conversation later. The stock, of course, gaining just in the first few seconds, Unilever, again, on the back of that beat and a raising of the guidance in terms of forward sales as well. Let's get more analysis then and bring in on the earnings picture Eleanor Taylor-Jollidan, co-head of Swiss and Global Equity at UBP. Eleanor, then, good morning. Some notable beats across the earnings picture today, whether that is indeed Unilever or Deutsche Bank or Barclays or in the US, Meta, as we look ahead to Amazon later today. Has the guidance been overly pessimistic on the earnings front?
Good morning. I don't think it's necessarily been overly pessimistic. It was cautious. Remember that at the beginning of this year, we were expecting 2023 to see a recession, perhaps not only in one region, but in several economic regions. And that hasn't actually come through. And the feeling about a recession going forward is we can almost certainly avoid it in Europe. And the US is probably also just going to be a slowdown. In any case, a recession in the US tends to be followed by a quick bounce back. So what we saw since the beginning of the year was that earnings were being revised down by the market. We were expecting positive earnings growth in 2023. Consensus was expecting positive earnings growth. And by the time we hit the beginning of the first quarter reporting seasons, there was much more of an expectation globally for a flat earnings development during 2023. So there's quite a big relief, I think, to see that the first quarter of this year has actually gone quite well across a number of sectors as well. As you mentioned, consumers have been much more resilient. That was a big surprise to me, I must say. And also we're seeing industrials managing to move through that big backlog they had at the end of last year in a successful way, thanks to a slightly easier supply chain.
And we can talk about whether or not that relative resilience continues in the quarters ahead. I just want to zero in on the banking sector, given what seems to be a bit of a diverging picture, the turmoil still in the US, particularly around the regional lenders, and the big question marks over First Republic, what happens there. And then you contrast that with the decent picture coming through from Deutsche Bank and Barclays and some of the other lenders in Europe. How do you think about the banking sector, Eleanor?
I think the banking sector may have become more regional than one would have expected in terms of slightly different dynamics economically, in terms of managing inflation as well in different countries. So the interventions of central banks, where we have seen a much more cautious intervention in Europe, for example, than what we saw in the United States in face of the respective levels of inflation in both countries. What I would suggest is happening on the banking sector is that it's very difficult operationally in any sector, in any case, to deal with sudden changes. And we've had one of the fastest rises of interest rates since the beginning of the last century. And that obviously needs to be dealt with by the banks. And they haven't necessarily always been fast enough to make sure that the deposits that they have are being remunerated. So they've lost deposits which have moved to money markets, which have moved to short duration fixed income products. And at the same time, they haven't necessarily had a pickup in the loan business that would have been as attractively remunerative. So they're dealing with a situation which has happened very suddenly. If we do see a slowing of interest rate hikes, I'm not expecting interest rate cuts, that will make the situation easier for banks going forward. Also, we're seeing that some banks may be unfit for purpose, if you like, by being too regional, by not having made some of the changes digitally, etc., that some of the larger players have made. And we're seeing this flight to safety to bigger names at the moment, away from some of the smaller, more regional names.
Okay, Eleanor Taylor-Jollidan stays with us, co-head of Swiss and Global Equity at UBP. The views there on the banking sector, the slightly pedestrian approach amongst some of those lenders in terms of reacting to this higher rate environment. Let's bring you, though, now our interview. We talked about Unilever and the beat there with the CEO of that business, the consumer goods giant, reporting sales growth then ahead of estimates in the first quarter. That's as consumer demand, as we discussed, proved more resilient in the face of these price hikes, more resilient than expected. Take a listen.
We've made a strong start to 2023, top line growth of 10.5%. Our volumes are close to flat. It has been strikingly broad-based. So if you look across all of our business groups, all are growing well, all are ahead of consensus and expectations, and our big brands are in good shape. Every one of our 14 biggest brands are growing well. We're executing quite well against our strategic priorities. I think if I had to call out one area, it would be the two new businesses that we've built over the last 4 or 5 years in prestige beauty and health and well-being, things like vitamins and supplements, have both now achieved 9 consecutive quarters of volume-led double-digit growth. And for example, one of our beautiful skincare brands, Tatcha, is launching this week in China. So if it's a broad-based performance, but if I had to pick out one area that we're particularly pleased with, it is the performance of our prestige beauty and health and well-being businesses.
And you've been guiding for a while that inflation was going to fall. Is it falling at the rate you anticipated?
Well, first of all, pricing remains elevated. We're extremely aware of the pressure that households are under. We said last quarter that we believed we were past or passing peak inflation, though not yet at peak prices. And that's certainly what we are continuing to see. There is more inflation coming into our cost base, 1.5 billion incremental in the first half. So costs are not coming down. They're just not going up as quickly as they were. And it's also more uneven. So beauty and personal care, we're seeing less inflationary pressure. But unfortunately, in our foods business, nutrition and ice cream, we're seeing high inflation in materials like dairy, sugar, cocoa, etc. So inflation is still here. It's just not quite as rampant as it was over the last 6 months.
So are supermarkets pressuring you to lower prices?
I think we're not at a point where anyone is seeing deflation and pressure to lower prices. We continue to have robust discussions with all of our retail customers about how necessary price increases are. But I can tell you we enjoyed good growth in Q1 with almost all of our major European retail partners. So it's robust discussion, but and we all want to resort to price as the absolute last measure, sensitive to how households are feeling right now.
But have you got the ammunition to be protecting margin going forward?
You know, it's an interesting point. What we're seeing is we're not seeing particular volume losses, nor are we seeing down trading. I think at a time like this, people are as concerned about the quality side of the value equation as the price side of the value equation. And the investments we've been making over the last 3 or 4 years on product quality and on innovation seem to be serving as well. So people don't mind paying when there is a quality offer. And so far, as you see, there's virtually no volume erosion in our results for this quarter. And we think it's because of the health of our brands and the investments that we've been making there.
But do you see any difference between the typical US consumer and the typical European consumer in how they're behaving in this inflationary landscape?
Actually, the more significant difference that we're seeing is strength in the emerging markets. 60% of Unilever's sales come from outside of US and Europe. And when we look across Asia, Africa, Middle East, or particularly Latin America, we see very strong resilience in the business there.
Okay, the CEO of Unilever, Alan Jope, speaking to Lizzie Burden earlier on the resilience within the consumer market, of course, raising their forecasts around sales. It's a big beat on the sales. All business groups growing ahead of expectations. Inflation, though, still boosting costs. Briefly checking on the stock price, currently up 1.5% in the session. Coming up, good news for big tech. Meta surges post-market after sales return to growth and user numbers beat. We will dig into the earnings next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware. And that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Historically, from the last Fed rate hike to recession, it's averaged 13 months. We're saying that the last rate hike will be in May. By November, December, you'll be in recession. Midway to recession, the Fed starts cutting rates. That's how we get to something like September.
JP Morgan's Bob Michael there speaking to the team in the US with his thoughts on where rates are heading. Of course, that debate remains live. We have GDP data and jobs claims out of the US later today. Let's bring back in Eleanor Taylor-Jollidan, then co-head of Swiss and Global Equity at UBP. Thanks for your patience, Eleanor. You touched on your views around the Fed. You are saying that they're going to pause. You don't see a cut later this year. Do you put more money to play on a pause? Or do you cut risk on a pause?
I would say that if we see a pause, we would continue with the investment strategy that we've had since the beginning of this year, because that has been part of our scenario. We simply don't see why the Fed would need to cut. In fact, we'd be quite worried if the Fed did cut, because it would suggest a significant worsening of conditions as compared to our scenario. With the labour market where it stands today, with the level of activity globally where it stands today, and also, as I think I mentioned earlier, the fact that when the US does have a little dip into recession, we have seen recently a very rapid ability for it to pull itself out of that situation. We would find it more logical for a pause to continue for the rest of this year, and there to be no need, especially with inflation currently at 5% and probably not going much further down. I mean, 3% would still, allow for an interest rate at 5%. So why cut too quickly? And I would prefer to see us working with money having some cost at least, in order for us to be able to make a good differentiation between well-managed companies, companies which are able to invest, and companies which are simply profiting from a somewhat unusual financial situation.
Okay, Eleanor Taylor-Jollidan, we appreciate your time and your insights. As ever, co-head of Swiss and Global Equity at UBP, on the view that the Fed does not need to cut this year. And if they did, in fact, that would be something of a red flag and a concern. Let's get the Bloomberg First Word News now with Sam Etienne. Sam.
Tom, the US House has passed a debt limit bill aimed at averting a catastrophic US default. In a political victory for Speaker Kevin McCarthy, the vote puts pressure on President Biden, who opposes the legislation's sweeping spending cuts, to open talks with Republican leaders. The bill passed by 217 to 215 votes, but has no chance of clearing the Democrat-controlled Senate. And Chinese President Xi Jinping has spoken with Ukraine's Volodymyr Zelensky for the first time since Russia's invasion began. Readouts of Wednesday's call suggest there were no major breakthroughs, though President Zelensky's office said the hour-long conversation was productive. She reportedly told Zelensky that negotiations are the only way out of the crisis. And Bloomberg has learned that Turkish President Recep Tayyip Erdogan has cancelled a day of campaign appearances after falling ill during a live TV interview. We understand he'll skip the opening of a power plant built in cooperation with Russia, instead joining via video conference. Erdogan is facing his toughest election in 20 years, with 6 opposition parties joining forces to unseat him. That's global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom.
Sam Etienne here in London. Thank you very much indeed. Let's get back to the tech earnings story then. Meta shares jumping post-market after sales returned to growth and user numbers beat. They have about 3 billion users now across all of their products. A rebound in digital advertising sales is giving the Facebook parent company time to invest in those speculative businesses like AI and virtual reality. Let's bring in Matt Bloxham then, tech analyst at Bloomberg Intelligence, for the details and the analysis. Matt, what do you make of the earnings? What really stood out to me was a line in the BN copy about the fact that he spent, 90 seconds talking about Meta, the metaverse, and about 6 minutes talking about AI. Do they need to rebrand again?
Well, according to Mark Zuckerberg, no.
Right.
The metaverse is still very much their North Star, but yeah, clearly, I think trying to kind of demonstrate that they are all over AI too, and it is going to benefit their business and improve the outlook. And I think we did see that come through to some degree. I mean, the big story, I think, in terms of that better than expected ad growth was Reels, which is their short form video product to compete with TikTok, and finally starting to get some traction with that, and AI has helped them to do that. So Instagram, time spent on Instagram up 24%. They're doing a better job of targeting short form videos at the right users. That's helping ad monetization. So it's all coming together, and AI is underpinning that. And Mark Zuckerberg said we've been investing in AI for many years alongside the metaverse. The two things go hand in hand. So just because the metaverse is our North Star doesn't mean to say AI is irrelevant to us. It is actually a really important part of our business and is contributing to the success of the Facebook platform, the Instagram platform, and even WhatsApp.
Yeah, unlike the metaverse, they're actually able to monetize
exactly.
AI. It's powering some of that growth around digital ad sales that came through, as you say, really strongly. What else are you looking for today? We have Amazon up next in terms of the earnings picture. So we've had beats from Microsoft, Alphabet, and Meta now. Similar picture for Amazon? Or
potentially. I mean, I think certainly going into numbers, people have been quite cautious on the cloud business, but people were thinking that too for Microsoft and Google too. So maybe there's a beat coming there. Obviously, the other big part of Amazon is their online retail business, so really a bellwether for the strength of the global consumer. So I think that's, I guess, where people's eyes are going to fall. I think. I mean, I think it is important if they can do better than expected on Amazon Web Services, their cloud business. That's the big driver of profitability at Amazon. So if they get some incremental revenue there, that will perhaps kind of reassure people that even though they've perhaps got some of their kind of cost model a bit wrong with demand on the online side, they can absorb it a bit better on the overall profit picture. And they're cutting costs that they've been laying people off alongside everybody else. So I think maybe they'll have a slightly more reassuring picture to paint on their kind of margin protection from that side of the story too.
Okay, so 2 key areas to watch for then, the e-commerce business and what that tells us about the strength of the US economy, and then of course AWS, the cloud services part of the business, that growth driver and profit driver. Thank you, Matt Bloxham, for the analysis there, taking us through the Meta earnings and of course a preview of what we expect from Amazon. Now, another tech story we are following closely, of course, Microsoft's $69 billion takeover of Activision Blizzard, the gaming industry's biggest ever deal, being blocked by Britain's antitrust watchdog. Was the blow finally fatal for this potential merger? We're going to ask Activision Blizzard's CEO, Bobby Kotick. That is later today, a really important interview to tune in for. That's at 4 p.m. UK time, 11 a.m. New York. Coming up, turmoil at First Republic deepens concerns about US regional banks. We bring you the latest next. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. Welcome to Balance of Power. This is Bloomberg.
In the last couple of weeks of March, our view is perhaps 1%. We saw of that 4%, 1% in that period. Interestingly, once March was over and we were into April, like a light switch, you know, the concerns around the banking industry went away, and we've seen deposits stabilize and grow over the course of April. I'd expect that we'd be back over 600 billion by the end of the month. And I think confidence has come back into the sector.
Okay, Deutsche Bank's CFO, James von Moltke, speaking to Manus Cranny, seeing deposit growth and expecting that to continue for that bank. Sticking with the banks, First Republic stock was halted 16 times during Wednesday's trade as its price continues to lurch lower. US regulators are also said to be weighing limiting the bank's access to borrowing from the Fed. Let's bring in Valerie Teitel then. Valerie, is there a rescue plan for First Republic?
Look, we're just waiting for a buyer to appear. You know, the lower the stock price goes, the more likely is that someone is going to come forward to buy the assets of First Republic. It seems like they might be hesitant to do this because they want to get the FDIC involved in some way, take on some of the losses and minimize the risk for them. And even First Republic themselves, and a lot of their restructuring solutions, you know, they wanted to involve the government, but the U.S. government so far seems a bit demurred to act. So it's a bit of a standoff between the FDIC and the buyers.
Okay, watching that standoff over First Republic. Stay with us. That's Valerie Teitel, of course, with a breakdown of what's happening with First Republic. Speaking of banks, we're going to have an exclusive interview with the CEO of Barclays. That's coming up. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are the top stories. European stocks follow Wall Street lower. That's as the continued First Republic turmoil deepens concerns about US regional banks. But the Nasdaq and US futures climb on strong earnings, with Meta sales topping estimates post-market. Amazon reports later today. Plus, Barclays shares jump as revenue at its corporate and investment bank tops estimates, fueled by strong fixed income trading. Let's get more on Barclays then. Traders at the bank have surpassed expectations in the first quarter with a surprise increase in fixed income revenue, helping offset falls in equities trading and deal making. Let's get to Bloomberg's Francine Lacqua then, who is with the Barclays CEO. Fran.
Good morning to all of our viewers and listeners on TV and radio. I am delighted to be joined by the Barclays Chief Executive Officers, Venkat. Thank you for joining us. First of all, congratulations, a pretty strong set of results. A lot of it has to do with FIC. What do you see in terms of main drivers going forward?
Yeah, thank you, Francine. Great to be here with you. And yes, it was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling, it's about up 16%, revenues up around 11%, 7.2 billion pounds, an excellent ROTE of 15% across the group, capital ending where we would like it to be, one of the, a record quarter of performance for the bank, and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are two parts I'd like to highlight. The first is the investments which we've made in our business. Whether it's in our credit card portfolios in the US, where we acquired the Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIC trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets, and that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers, and that at the right times in the market, that they all are there and they click. So, you know, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US, and I'm sure we'll talk about that. The first quarter a year ago was about equity vol and single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually people, corporates, putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably, but it's also, for us, it's a deposit franchise that we've built over decades, right, with a very nice mixture of individuals, of corporates, small businesses. So,
but do you expect the worst of the banking turmoil to be over? It's unclear. Some people think that there was a banking turmoil in March. Yeah. Others say, look, it's two specific cases for two specific reasons. How do you see it going forward?
So I think the Credit Suisse was a very specific case. Yeah. While I think Silicon Valley Bank was a specific case in terms of its circumstances, it has highlighted an issue with some of the regional banks in the US. And that we will see continuing to play out maybe in a small number of names. And we've seen First Republic over the last couple of days. So I expect that we will see over a small number of names. It's not going to be systemic in any way, but there will be repercussions.
And it hasn't changed the way in which Barclays behaves at all. As you said, the UK was pretty immune to that. Are you looking, for example, at possibly buying Credit Suisse assets?
So the UK has been immune from the deposit franchise. Obviously, what's happened in the US and with Credit Suisse affected market volatility, especially in interest rates, and that our trading businesses engage in. Coming back to assets, look, we have built up our business over quarters and years. We have, when Credit Suisse got out of the prime business, we hired a few of their people and some of their clients chose to work with us. So we were happy about that. I think a lot of the asset shifting happened before this period.
When you look forward into what the banking, the banking world looks like, are you expecting more regulation? Or are you expecting also consumer behavior as we possibly go into a downturn?
So on the banking world, I think regulation will, with some delay and with some benefit of perspective, look at what happened in March. And whether it's thinking about liquidity, whether it's thinking about, the digital nature of liquidity, how fast people can withdraw, I'm sure they're going to look at it. They're also probably going to look at how they supervise big banks versus smaller banks. So I imagine there's going to be some of that, and I think we'll see the first installment in the US when the Fed is giving its own report, I think on the 1st of May.
But do you see distress in the market? It's pretty incredible to me to look at interest rates going from 1% to 5% without that much breaking.
Yeah. So I do think that you're seeing an impact on consumers. That impact has been really, really cushioned by the starting conditions because people had more wealth and by employment continuing to hold. So people have jobs. So for instance, if you look at the UK, two things. We expect for the median two-family household with a median house that compared to spending about 20% of their income on mortgages, on mortgage payments in the decade 2010 to 19, by the time this year ends, it'll be about 28%. So that's a reasonably big number. We've also seen that in March, when we look at the spending data of our customers, debit card and credit card customers, what we've seen is that while inflation year over year was, call it 9%, their expenses went up about 4 or 5%. So they're economizing. They're either buying items that cost less or they're spending less normally. And I think so people are managing their balance sheet. What we have not seen is signs of distress among customers.
Which is a good thing.
Which is a great thing. Which I think people are economizing. They have jobs, which is great. That's why it's important to have economic growth.
So we heard from the chief economist of the Bank of England saying, look, people should accept in the UK that they will be poor. Is that what you're seeing? I mean, is that kind of the pattern that you could see in terms of consumer spending?
So, yeah, I saw the choice of words, and I'm not going to dispute the Bank of England. Here's what I would say. People are shifting their consumer spending, I think, from more expensive to less expensive, and they're choosing what they spend on. Sometimes that might just be better, right? But it's obviously happening because of inflation pressures.
But it's readjusting. You're not seeing something worrisome in loans. I know there was an impairment actually in your numbers.
Yeah.
So, you know, what are the details on that? There's something impending that could actually really be worrisome.
We're not seeing, except in the very fine margins of very low rates, some increase in stress. We're not seeing that at all. The impairment you're seeing, our impairment number was around £500 million compared to about 150 a year ago. Most of that is the buildup of the balances in our US cards portfolio, where it's sort of automatic. We build up balances, we create impairment.
When you look at the world, what worries you in terms of regions, in terms of spending, and how does that impact your strategy? I know India, for example, is increasing its wealth quite significantly. Do you have a strategy specifically for India?
Yeah, I mean, India is a very good question. We have long had a very strong investment banking presence in India, and it has contributed well to us. And in fact, we participant in many transactions last year. So I think we will continue to invest in people and our capability in India. You know, other parts of the world, I mean, we have generally we've concentrated on Europe, the UK and the US. We've got a footprint in Asia, which is India, Singapore, Hong Kong, and Tokyo. And we expect to keep that footprint.
Did the Ambani saga change anything in how people invest in India?
I don't think so. It seemed particular to that company. And that company seems to have taken quite a lot of steps to improve its own financial position. So that's good.
Is there anything in liquidity that you worry when you look at the functioning of the markets?
It's much better now than it was 6 months ago, particularly in gilts. So let's begin here at home in London. The gilt market, as you remember from September, October,
was quite something.
That market has, the strains in that market have considerably improved. And you can see it in the improved quality of sterling. I mean, sterling is eking its way back up. So that market has improved. I think in the US markets, there have been spots of illiquidity in treasuries and even in corporates. And, you know, we have the debt ceiling issue ahead of us, so we have to watch.
What does the debt, I mean, worst case scenario for the debt ceiling, and I don't know whether you actually model this, worst and best case scenario. So best case scenario, nothing really happens.
Yeah.
Worst case scenario, could we actually see a US default?
I very much doubt it. I very much doubt it. I think we've gone through this before, and solutions always prevail, and people in Washington are beginning to talk, and there are proposals on both sides of the aisle in Washington. So I think all of us have to prepare for these eventualities, but I doubt this eventuality will come.
We're here in Canary Wharf. You have the most beautiful, actually, view, I think, of all of London.
Thank you.
Committed to Canary Wharf and London?
Yeah, well, we've just built 4 new wonderful trading floors in this building. And so we have invested in this building. We've invested in Canary Wharf and in London, you know, and across the UK. You know, we've built a wonderful campus in Glasgow. So we do like to have a presence across the UK.
You've also come back after, you know, a tough year.
Yes.
What's it been like coming back?
Thank you. It's actually been wonderful to come back. You know, I was sick and I worked for a few months through my treatment, but I worked at home. And sort of to reflect on that and reflect on the hybrid situation, what I can say is personally, I have experienced the joy of being back in the office, of being able to interact more casually with colleagues. And I think it's improved my productivity and it's improved my frame of mind. So I'm very happy to be back.
Has it changed the way you see actually the hybrid working model at all for your employees?
made something that was, in my mind, intellectual, more tangible, which is I always knew that there was a benefit of being in person and being around the office. And now I've experienced it, because it's one thing when you're in COVID and everybody is away. It's another thing when you're sick and you're alone, but everybody's in the office. Not all the time. Now, there are many benefits that have come from hybrid working, which we should all use and which we should capitalize on. The flexibility and the acceptance of flexibility, which is, I think, the most important thing. And so we want to keep that. We don't want to, dispel it. I'm very happy to say we were very satisfied. Barclays UK, in the UK, we've been named for the 3rd year in a row as the LinkedIn Employer of the Year. So we hope that we are trying to get that mix correct.
How do you view AI? That's the big question.
Yeah.
We don't have an hour, unfortunately, to talk about AI.
So the most important thing for me in that is to try to educate myself on it. From everything I understand and what I have seen, it is and can represent a remarkable improvement in productivity and find ways to do certain tasks better by being able to map relationships as opposed to just a listing of facts. So I think the potential is enormous, and I think it behooves all of us and organizations to try to understand what it is. I'm sure it will always be more than what we thought and less than what people, the people who are the greatest enthusiasts believe.
But Venkat, so what does that look like at Barclays? Are you deploying, and I don't know whether this goes back to costs, maybe costs were a little bit disappointing, but you also have to grow and invest. Is there a parallel to what you could achieve with AI or new technology?
So that's a very good question. I think there is. I think in the end, efficiency will come from technology and digitization. And the question for us, for instance, in AI, is when you're looking at patterns and you're looking at relationships, one of the areas where we see a lot of it is in financial crime, AML, KYC, relationships between transactions. Is there a way to do this better that brings efficiency and brings actually better performance? Our own costs this quarter, coming back to that question, we have invested in our businesses. We continue to invest. And those investments have been profitable. And we take it very carefully and deliberately and over many quarters. And what you've seen in this first quarter is what I think would be the peak of our investment for this year.
Anything that worries you actually in the next 2 to 3 years? I mean, today was a strong day.
Yeah.
I think we're also looking at, FIC, and the only bank that did as well as you was probably Bank of America. How hard are the next 12 months going to be?
So I think there are 3 parts to that. One part of hard is how's the environment going to be? And I think that's a little hard to predict. I mean, we've been very cautious for the last number of quarters. But if you told me on the 1st of January of this year that in the first quarter, the sector that would be in crisis is banks, I wouldn't have believed you. Right?
No one would have probably.
So the thing is, we don't know. So I think that volatility alone, while it brings opportunities in certain businesses for us, is something that gives us caution, right? The investment banking landscape. Now, we did well in investment banking. We actually had very strong results, but we were the least negative, right? So that business itself is smaller for across the street because fewer deals are getting done, IPOs are scarce. So we think those are all things that weigh against it. I think on the consumer side, while the consumer is still holding up, if the pressure continues for longer and longer and longer, we have to worry. So I think it behooves us to be cautious. Yeah.
When are you expecting all of the pipeline of deals to come back, to normalize?
I think you've got to see the end or the signs of the end of the interest rate cycle. When you and I last spoke in October, I had said I thought it would be in the middle of this year. I still think, give or take, it could be the third quarter. I think what's happened with banks is probably, and the worries about, especially in the US, how much credit might be extended into the economy from the region, or might not be, because of the issues with the regional banks, could postpone that point. So we have to see, but it's probably closer to the end of the year than the middle part.
So so this is basically monetary policy transmission, right? The fact that it could take up to 18 months. Right? I mean, everyone or the market is expecting cuts from the Fed.
Yeah.
Is that your base case?
No, I think first we have to see the stop. We have to see interest rate rises stop, and then I think there will be a holding period.
A holding period, so we have higher interest rates for much longer. Is this a new normal?
Well, it could be an old normal. I mean, 30 years ago, this is what it was, right? When I joined this industry, the Fed funds rate was around 5%. So the question is whether what we've seen in the last 20, 25 years was an abnormal period of low interest rates. And what we're going back to is actually what it should have been over the much longer period of time.
Is that how you see it? That this is normalizing instead of the new normal?
I think I see it personally as normalizing, but that may reflect my age more than anything else.
But it changes. I mean, I guess it also changes trader, psychology and market psychology. If this is going to be for the foreseeable future where we are.
It does. I mean, first of all, if the risk-free rate has now become 5% instead of 0, then it changes the hurdle for a whole host of investments, which is what you're seeing, right? What you're seeing in the market. The second is the transition from 0 to 5. While it was well telegraphed, not very many people have lived through it. And you are seeing that again in the way in which certain asset portfolios have reacted to rising rates. We have tried to position ourselves carefully for it, but nobody gets this perfectly. And then once you stay at that higher level of rates, we've got to look at what volatility there will be and how business models evolve. And you're right, that's going to be new and different.
Venkat, you also have a former shareholder activist of Barclays that says there should be a probe into, directors' ties with Jeffrey Epstein. Like, what's your response to that?
Well, so two things. I think, first of all, there are new allegations. Our board has spoken about these new allegations. They're serious. We're in no position to comment. I'm in no position to comment. They're being adjudicated in New York, and we are not party to that. So I have no view on that. I know our board well. They're very thoughtful, deliberative people. And while I was not a member of the board, I know individually and collectively that they employ very careful and detailed processes to reach their decisions.
Venkat, thank you so much. That was, of course, Barclays Chief Executive Officer. And I also need to correct myself because I think I meant Adani instead of Ambani. So that was my fault.
That's okay. I knew who you meant.
Thank you so much for your time with us today. With that, I'm going to send it back to you in the studio.
Okay, Fran, thank you very much indeed. Right, coming up, we're going to focus back on the earnings picture as well. French drug maker Sanofi's profit rises more than expected. In the first quarter, we get more with the company's CFO. That's at 9:10 a.m. London time. Stay with us for that. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
DOJ or other authorities
could face bigger challenges. Britain's next
was going to keep Green World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Welcome back to the Open. 54 minutes into the European trading day. The picture has turned a little bit more positive for European equities, currently just clinging on to gains. Futures in the US also pointing high by 0.9% on the Nasdaq futures, by 0.4 now on the S&P E-minis. It is technology, it's the earnings picture that is reviving these markets, at least around the fringes, as we continue to assess the potential fallout from First Republic and the tussle there between some of the big lenders and the regulators around the fortunes of that bank. We've, of course, on the earnings front, had a number of pretty decent beats, both in banking, in consumer and tech, with Meta really leading the way in terms of ad sales. Let's check in on some of the sectors on the move then. Across the European space, top of the list, auto is actually gaining a full 1%. Banks also near the top of the list as well. And of course, Barclays can be tied into that. Kazkan, Deutsche Bank, both coming through with beats, although a different picture when it comes to the trading divisions of both of those banks. Bottom of the list for you, media currently down 1.7%. Chemicals also taking a hit, down a little over 1%. Let's check in on some of the individual movers then. Just speaking to the CEO of Barclays around that beat. The bond traders at that bank really driving the profits in terms of the beat there. Retail margins also rising, benefiting from higher interest rates. And the CEO saying that they don't see a lot of distress amongst US consumers, UK consumers, and that the US banking turmoil is not a systemic risk. There's a deal in the offing around Deutsche Börse, and this is for a software company that they are bidding for a premium of around 39% on SimCorp, which is a Danish company. Deutsche Börse looking to buy that for around 4.3 billion, and the stock falling on the back of that news, down 6%. ST Micro, it came in with a beat, in fact, some resilience in terms of the demand, particularly from their auto clients, but it's a loss of 4%. Analysts telling Bloomberg that there was no big surprise when it comes to the numbers out of ST Micro, so maybe a bit of a profit take there for the chip maker, and maybe broader concerns about the semiconductor space in the quarters ahead. That is a little picture of some of the individual stocks on the move. Deutsche Bank, I touched on this briefly, 2.7%, so a solid gain there. FIC, a bit of a disappointment, but at the top line, you had revenues beating the best beat for revenues for that bank since about 2016. We were speaking to the CFO as well earlier around the prospects for the bank, again, in the quarters ahead, and painting a relatively positive picture. Let's take a look at some of the events we're following today, just very briefly. 12 p.m. UK time, Turkey's rate decision. Of course, when it comes to the US, you have GDP data, but also those US jobless claims, what it's going to tell us about the health of the US economy, whether we are now on the fringes of a US recession. There's plenty more coming up. Your US futures pointing to gains. This is Bloomberg.
idea is we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. European stocks are mixed as the continued First Republic turmoil deepens concerns about regional banks. The Nasdaq and U.S. futures climb on strong tech earnings. Meta sales top estimates post-market. Amazon reports today. Plus, Barclays is trading higher after its corporate and investment bank top estimates amid the recent banking turmoil.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us.
We'll get more from Francine's exclusive interview later, and that is precisely why I'm here, and she is currently not. Of course, she was just over at Barclays talking to the CEO there. All right, when it comes to these markets, European stocks just barely pushing higher. U.S. stocks, those are doing better, but it was 2 consecutive negative sessions counting yesterday. It's those fears over First Republic. We are buying some more now. It's the tech earnings that are fighting through the noise. Meta outperforms. Then 5-year yields, those are climbing higher yet again. The buying has been concentrated on the belly of the curve. Again, it's this idea, is there more of a Fed pause? Do they stop hiking sooner? Do they start cutting if we are still concerned about banking turmoil? Finally, Bitcoin, that's having a good morning. It was trading near 30,000 at one point, but liquidity is thin, so it tends to bounce around more. But even so, it is clear that there is some risk appetite in this market. Looking across regions, again, it is a mixed bag. The catalysts are that of earnings. We did have some disappointments when it came to Deutsche Bank, so the DAX not performing as well, their FIC trading not keeping up. Yes, we did have a strong Barclays results, but still when it comes to the FTSE 100, that is more or less flat. CAC and FTSE MIB, those doing better, up about 0.3%. Now, I mentioned that Meta earnings were really good. We're just getting the print on the pre-market trade. I want to show you that 11.33% is where we stand on the pre-market trade for Meta. Their sales coming in really strong. Advertisers, they want to spend. They want to spend with Facebook. Again, that doesn't seem like an environment where we're necessarily in a recession if these corporates are willing to do that. But Meta also talking about the fact it means that they can spend on some more of their more growth areas, things like AI, which is the buzzword for every company these days, things like AI and virtual reality. So that's the Meta share price read, but let's go back to the Barclays story. Shares there are higher this morning. The UK lenders' fixed income revenue beat estimates. Francine Lacqua spoke exclusively to the CEO moments ago.
It was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling. It's about up 16%. Revenues up around 11%, 7.2 billion pounds. An excellent ROTE of 15% across the group. Capital ending where we would like it to be. One of the, a record quarter of performance for the bank, and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are two parts I'd like to highlight. The first is the investments which we've made in our business. Whether it's in our credit card portfolios in the US, where we acquired a Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIC trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets, and that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers, and that at the right times in the market, that they all are there and they click. So, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US. The first quarter a year ago was about equity vol and single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about 10 billion pounds during the quarter. And a lot of that was actually corporates putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably, but it's also for us, it's a deposit franchise that we've built over decades, right? With a very nice mixture of individuals, of corporates, small businesses.
The Barclays CEO there, and we're going to have more of that exclusive interview on Bloomberg UK in about 30 minutes' time. We're also getting a read now on the pre-market trade for First Republic. It is up, but it's up slightly compared to the drop we've seen, so up about 7.5%. Now, usually that's a lot, but these shares have fallen 64% in just the past 2 days, taken together even more than that. So its value has been halved and then halved again and then halved again quite significantly. But still, shares up pre-market. But yesterday, their stock was halted 16 times. Its price continues to lurch lower. As I said, it dropped 30% on the day yesterday. U.S. regulators are also said to be weighing limits to the bank's access to borrowing from the Fed. For more on this, let's bring in Bloomberg's Valerie Teitel. Valerie, is there any sign of a rescue deal for First Republic?
Look, we're just sitting and waiting for a buyer to appear, and the lower the stock price goes, the more likely is someone's going to swoop up and buy it. But it seems like there is a bit of hesitancy from these potential buyers because they want the government involved somehow in order to protect them, from any financial risk of the losses being more than they expect. And so it's all about, where do these losses sit? Are they going to sit in the private sector on the bank's balance sheet who buys them, or are they going to sit with the FDIC if they take them into receivership? So far it seems like the government is a bit demurred to act in terms of helping with a restructuring solution. So it's become a bit of a standoff between these potential buyers and the FDIC, who doesn't seem to want to give any assistance.
What are their options in terms of assistance, in terms of, I guess, making this more attractive to banks?
Well, look, a lot of the options seem to have been closed now. Remember, it was a few weeks ago, it was rumored that the Fed might expand their BTFP facility in order to take more different kinds of collateral, because First Republic doesn't really hold that many treasuries it can use to lend against with that new facility. But that seems to be, far gone now with the stock price trading so low. And then we heard from the FDIC themselves, they're looking to potentially downgrade their assessment of the bank, which would prevent it from accessing the Fed's discount window at all, which would be, close the doors on the bank essentially. And, it's very unlikely the FDIC would give uninsured depositors some special treatment. So it seems like the option for the FDIC is to put it in receivership, but they don't want to do that because then they sit on the losses. And remember, they're already sitting on $30 billion of losses from the first 3 bank failures.
Quickly here, Valerie, and I know this is a big ask to do this quickly, but what has the market reaction to all this been?
Well, thankfully yesterday the stock price plunge didn't drive a wider risk-off move. But let's remember the issues facing First Republic is that its business model just does not make money with a Fed funds rate at 5% and their loan book making less than that. And that is something that is shared with other regional banks around the U.S.
All right, Valerie, thank you so much. That's our markets reporter, Valerie Teitel. Now, coming up, Sanofi profit beats estimates as the French drug maker's blockbuster treatment advances. We're going to be speaking to the CFO, Jean-Baptiste Chatillon, next. This is Bloomberg.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Sanofi's profit rose more than expected in the first quarter. That happened as the French drug maker's blockbuster therapy, Dupixent, gained market share. The company's best-selling product is used to treat ailments ranging from asthma to severe eczema. We're joined now by Sanofi CFO Jean-Baptiste de Chatillon in Paris. Jean-Baptiste, great to speak with you this morning. It's clear that Dupixent, a really big growth driver here. But when you look at the rest of the year, what do you see as the biggest contributors to growth? Where do you squeeze that out for 2023?
Yeah, thank you, Danny. It's really an interesting start of the year with this top-line growth of 5.5% at constant exchange rate, and with an EPS growth, double-digit, 11.9%. We have really a strong start in 2023. But as you say, we have now several growth drivers which are showing up. Of course, Dupixent with a new extension to a new indication, COPD, you know, this chronic bronchitis, which is really a major cause of death around the world. And we are going to bring on a fully unmet need Dupixent to this indication. And so that's a great news for patients. But beyond this, and to answer your question on the full year, we will be presenting new growth drivers today on incoming events during the year to present the progress on our pipeline. We are launching this year three important products. We just mentioned Altuvio in hemophilia. We are launching Beyfortus, which is addressing another huge unmet need with RSV. You know, this virus, which is the first cause to bring babies into the ICU. And we have a product which can really prevent this on a massive scale. So great news for patients coming during the year 23, which are growth driver for the rest of the year, but also great news coming on our pipeline.
Yeah, well, when it comes to Dupixent, you mentioned the COPD, the use case for that. What does the timeline look like? How soon could you file for approval, regulatory approval, when it comes to that use case?
Well, that's a great question, and we have good discussion with the regulator. So answer coming later when we have finalized those discussions. But of course, when you have a major unmet need like COPD, and there's no available drug to really address this issue, we have great hopes that it will be a quick resolution to go to market with this indication.
Jean-Baptiste, as someone who works in TV, I love a good teaser, which is exactly what you just gave us. Look, the market view is ahead of your 13 billion euro target when it comes to your blockbuster drug, Dupixent. Why not raise your peak sales estimate?
Yeah, well, that's a great point. And we are dimensionalizing. We are looking into it. But, you know, many people now have very good estimate on where it can go. I think for us, and we'll come back later on in the year with our best thinking about it, but for us, it's also looking at the broader pipeline of immunology. Dupixent is just the beginning of our leadership in immunology, and we'll present, even today, some advancements on other products in immunology, like our CD40, frexalimab, which will show what is the future beyond Dupixent. Quite interesting.
When it comes to Zantac, of course, it's the heartburn medication that was drawn from several markets with fears of contamination with a likely carcinogen. Last month, the California court allowed a Zantac case against GSK to go forward. When you look at your exposure to some of these issues, what is, as you see, the trial risk involving Sanofi and Zantac? Are there more risks of that?
Well, Denny, I think you use the right word by talking about fear of a risk. But as you know, there is no medical evidence, no scientific evidence of any link between this drug and any cancer. And that was pretty well described in a historical ruling from the Daubert case. And after this Daubert case, really, for us, we don't see this issue around Zantac impacting in any case our strategy or our business. So we're just on a business as usual trend. So it's not a major issue for us.
Jean-Baptiste, before we go, this one's a little bit out of left field, but look, AI has really been the buzzword this earnings season. We've seen, I mean, at least the tech companies mention it, at least 50 times in their call. When you think about the pharmaceutical industry as this technology rapidly evolves, what do you think will be the biggest disruption to your industry?
Well, it has started already. Sometimes maybe this industry, we don't talk sufficiently about what we do in tech. But let's just discuss about Dupixent. How did we identify what were the indications where we had the most chance with this drug to succeed? Well, with AI-driven algorithm. And that's quite interesting when we apply to our research programs. When you have a molecule where you see it's effective with a great safety profile, you can then find out or ask AI to come back to you with where it could be most efficient for patient. We use it. It's already real in our company.
All right, Jean-Baptiste, we're going to have to leave it there. Really great speaking to you today. Sanofi CFO Jean-Baptiste Deschâtellion. Now, coming up, Meta shares are up pre-market, a rebound in digital advertising sales, and forecasts better sales ahead. More on that next. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Let's get your first word news. With that is Leanne Gerrans. Leanne.
Danny, good morning. The U.S. House has passed a debt limit bill aimed at averting a catastrophic U.S. default in a political victory for Speaker Kevin McCarthy. The vote puts pressure on President Joe Biden, who opposes the legislation's sweeping spending cuts, to open talks with Republican leaders. The bill passed by 217 to 215 votes, but has no chance of clearing the Democratic-controlled Senate. Now, Bloomberg has learned that Turkish President Recep Tayyip Erdogan has cancelled the day of campaigning appearances after falling ill during a live TV interview. We understand he will skip the opening of a power plant built in cooperation with Russia, instead joining via video conference. Erdogan is facing his toughest election in 20 years, with 6 opposition parties joining forces to unseat him. Chinese President Xi Jinping has spoken with Ukraine's Volodymyr Zelensky for the first time since Russia's invasion session began. Readouts of Wednesday's call suggest there were no major breakthroughs, though President Zelensky's office said the hour-long conversation was productive. She reportedly told Zelensky that negotiations are the only way out of the crisis. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. All right, a quick check on Meta in the pre-market trade, up more than 11% off the back of strong earnings. Advertising spend, that is still going strong. Meta saying that they're also able to spend when it comes to things like AI. Joining us now to discuss is Matt Bloxham, tech analyst at Bloomberg Intelligence. Matt, what was the takeaway for you?
Yeah, I mean, as you pointed to there, the resilience of ad spending, I think that's been a surprise across the board this quarter. And for Meta, you know, after 3 quarters of top-line decline, a rebound, small but growing 2.5%, was a strong signal that having had a lot of pressure from TikTok and having to adjust to the changes in Apple's privacy rules, that they've actually got the kind of core ad business back under control, and it's got some positive momentum again, particularly in Instagram, where their Reels product is starting to kind of get more ad impressions and more user time on the platform. So encouraging signs.
Is there a contradiction between Meta and Zuckerberg, who says this is the year of efficiency, we're cutting down on costs, and discussions of spending on AI and growth there and growth in virtual reality?
I don't think that, I mean, certainly if you've been on the wrong end of layoffs, then you're going to be asking that question. Yeah. But I guess part of this is that there needs to be a big pivot in where they're employing people. And perhaps they've just had too many people in the wrong parts of the business that aren't kind of driving productivity or sales. And they need to double down on the AI and the metaverse investments, which are expensive. People there are probably even more expensive than other parts of the business. So I think it's a bit more of a shift in where the resources are focused, rather than bringing the entire kind of operation down a peg or two.
About a minute here, Matt, but I know you cover other companies exposed or in the digital advertising game. Was it improvement across the board?
I think generally, I mean, we've seen quite a few of the ad agencies report in the last week or two, including WPP today. Generally, the ads industry has been holding up better than expected. The agencies are still being quite cautious about the full year outlook, though. And I think we've heard some of that with Google earlier in the week, too. So I think, it's a bit like, make hay while the sun shines at the moment, but don't get too carried away about the second half of the year, because we might see some bigger headwinds as campaign budgets are cut.
Right. All right. Yeah, certainly those fears of recession alive and well. Matt, thank you so much. That's Matt Bloxham, our tech analyst at
Connection
Bloomberg
lost.
Intelligence. Now, coming up, we're going to get more from our exclusive interview with the CEO of Barclays. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight, because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. Do you think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Good morning and welcome to Bloomberg UK. I'm Danny Berger in London. You're looking at a beautiful shot of the city this morning. Now, this week, we're going to focus on bank earnings, financial stability, and our exclusive interview with the chief executive of Barclays. Now, shares are higher this morning as the UK lender's fixed income revenue beat estimates. We spoke exclusively to the CEO earlier.
It was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling. It's about up 16%. Revenues up around 11%, 7.2 billion pounds. An excellent ROTE of 15% across the group. Capital ending where we would like it to be. One of the, a record quarter of performance for the bank and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are two parts I'd like to highlight. The first is the investments which we've made in our business. Whether it's in our credit card portfolios in the US, where we acquired a Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIC trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets, and that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers, and that at the right times in the market, that they all are there and they click. So, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US. The first quarter a year ago was about equity vol and single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about 10 billion pounds during the quarter. And a lot of that was actually corporates putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably. But it's also, for us, it's a deposit franchise that we've built over decades, right, with a very nice mixture of individuals, of corporates, small businesses.
The CEO of Barclays speaking exclusively to us earlier. Coming up, we're looking ahead to more UK bank earnings next week, how they have fared this past quarter amid the global banking turmoil. We'll discuss all of that next. This is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Top-line growth has been really strong for us, so we're up 13% on our top-line growth. We were up double digits last year, so the overall performance of the business has been fantastic. The profitability is now up at the levels we last saw back in 2015, so a long period of time since. Interest rates going up has clearly been a help in that, but also we have seen a lot of client demand as particularly the Asian markets now pull through the COVID period and start to look forwards.
Does that mean that even if the Fed, the BOE, stops hiking, that interest income margins will have peaked, or is this not the peak yet?
So last year, our interest margin was about 1.4%. We have said this year we think it will be about 1.7%, and we have said next year we think it will be about 1.75%. So we are sort of nearing a higher level, but still on the rise.
So if everything looks good, profitability is still strong, your figure of $5 billion worth of capital returns by 2024, would you say that's a conservative figure then?
Well, we need to start somewhere. So $5 billion, we are roughly halfway through excuse me, in terms of what we have announced so far. $5 billion coincidentally will be the amount that back in 2015 we raised as a rights issue, so essentially it will be handing that money back. But I'd say overall we're well on track for delivering the $5 billion.
Are you still fearful that the worst of the contagion, again, emanating from a market far away from yours, but are you fearful that perhaps that's not over yet?
There obviously have been two major issues in the sector, but actually for us as a business, we have actually seen our numbers stay incredibly solid. So our deposits have remained very, very stable throughout the period. So not that anybody is totally insulated from something going on in the sector, but I do think the fact our businesses are more based in other parts of the world, we are very spread. Our deposits are spread across many countries, many different types of client. I think actually our business model is a very robust business model for this sort of circumstance.
Well, almost, I mean, perversely, does it help you? And I'm thinking here specifically of Credit Suisse. Did you see flow that was clearly from them, clearly from their clients, especially in wealth management, fleeing Credit Suisse and coming into Standard Chartered?
I think if you look back over the last probably 6 months or so, particularly last year, we saw strong growth in our assets under management. I think some of that was probably helped by some shift away from some banks like that. So I think this will be a flight to safety. I think the bigger, more robust institutions that have been around a long time, are trusted, will be the beneficiaries of this.
In January 1st, Abu Dhabi Bank said it had explored a deal with Standard Chartered to buy it. Since February, it said it's no longer planning to do so. Have you had any conversations with them since? Is Standard Chartered, is the future still an independent bank?
We have had no discussion with them whatsoever. We are an independent bank. We are motoring well under our own devices. We're very pleased with our performance.
Standard Chartered CFO Andy Halford speaking to me there after releasing its earnings yesterday. Now, Standard Chartered and Barclays are just two of the biggest London-based banks that have reported earnings this week. Investors at this point are seeking more clarity on the health of the global economy and if there are any signs of fallout from the turmoil in the banking sector. And of course, we can't forget the Brexit impact either. Bloomberg recently revealed that Paris has been seen a surge in top-paying bank jobs. So we have a lot to cover here. Joining me now to do so is our city editor, Catherine Griffiths, and William Shaw from the Bloomberg's finance team. Thank you both so much for joining today. Will, let me start with you just when it comes from what we've heard from the banking sector so far, specifically in the UK. Barclays, Standard Chartered, just heard from both of them. What have been your big takeaways?
So like you were saying, this is the first real indication of what negative effects banks might have experienced from SVB and Credit Suisse going down last month. The immediate answer seems to be everything's looking pretty good. So if you look at Barclays, their FIC traders have beat estimates. Their fixed income traders have seen revenue up 9% to £1.79 billion in the first quarter. Now, that's actually compared to analyst estimates of a drop of 11%. So that comes against a backdrop, effectively, of high interest rates, which are creating volatility in the market and creating opportunities for traders to bet on what rates and what inflation are going to do next. Standard Chartered as well has had very positive results. So yesterday we saw they'd had their best quarter since the first quarter of 2014. Again, that's partly a function of interest rates and partly it's about economies in Asia accelerating their exit out of COVID-related lockdowns. We've got NatWest, HSBC and Lloyds now to watch for further indications.
One of the things at Barclays that came on strong were its deposits. It's on increase when the fear at the moment for many banks is deposit flights. I just want to quickly play for both of you the comments from the CEO and get your thoughts. Take a listen.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us.
So, Will, I'm going to start with you again here. Why has the UK been more insulated?
So there's a couple of reasons for that. I mean, first of all, if you look at what happened to SVB, so smaller banks like SVB in the US they received a carve out from stress testing requirements, which meant no one ever got an indication of what would happen to a firm like SVB when borrowing costs rose sharply. The UK never provided that kind of carve out, and therefore they haven't faced the drama that banks in the US have. Regulators point to Virgin Money, which is an equivalent sized bank to SVB in the UK, and there are no obvious problems with Virgin Money.
Catherine, does that mean regulators are off the hook if we're not having that deposit flight like is occurring in the U.S.?
I think they wouldn't want to say this definitely publicly, but I think privately they do slightly feel quite pleased with how things have gone in the UK, as we saw the dramatic difference in SVB in the US and SVB here in the UK, which was sold to HSBC over a single weekend. They would say about that it was possible to sell the UK business because it was in far better shape than some of those US regional lenders, and they would trace that back to things like making sure that the UK part was subsidiarized, so it was entirely regulated here in the UK from last year, and that made it in a much better position to enact the sale.
Well, Andrew Bailey did raise the prospect of increasing the level for UK deposit insurance to $85,000. Jeremy Hunt, if I'm not mistaken, followed up with a similar comment, coincidentally or not, at very similar times. What is the likelihood of that happening?
I think it's really quite likely that they will raise the level, the £85,000 here in the UK. It's lower than in the US, where it's $250,000, for example. But the question, of course, is to what point will they raise it? There's been talk about whether we could potentially guarantee all deposits in the system. It just wouldn't work in a country like the UK, where financial services and deposits are such a big part of the economy. It might threaten our credit rating as a country, potentially. So they've got to find other ways to inject more confidence into the system. So we'll definitely see, I think we'll definitely see the limit being raised, but we'll see other measures being taken to try to make sure that when there's the next problem, as there inevitably will be, and of course it won't look the same as SVB, it will look different in some way, that people don't immediately rush to take their money out, because that's the huge challenge we now face in this internet age. SVB in the US, people took out the amount of deposits that you might ordinarily think in a problem time in a month. They took them out in a matter of hours.
Right.
You can never kind of deal with that apart from on the other side of things, which is about confidence and making sure systems work well.
And I guess now you can also tweet about it. You can make a TikTok that you're getting your money out. So that sort of word travels so much more quickly. Will, how would big banks feel if they had to put more into a deposit insurance fund? Would they be upset with regulation like that?
Well, so John Vickers, who's one of the architects of UK financial regulation, has told Bloomberg that these changes to deposit guarantees would require higher capital charges on banks. Obviously, banks don't like their capital charges. It limits the amount of money they've got to invest elsewhere. It's likely something that would cause a lot of consternation in the banking sector. So there would probably be a discussion, you know, what's more important for us here, to make sure that we're protecting retail consumers, or to appease the lenders on the amounts of capital reserves that they need to hold, and making sure that they're not being prohibited from doing business unreasonably.
So we're gonna, in just a bit, talk with our tech reporter about the UK CMA turning down or blocking the deal between Microsoft and Activision. So I don't want to get into the details too much, but Catherine, there has been this ongoing fight of whether London can reign supreme in terms of a financial center, whether companies want to list here or list in the US. Is there some element of discouraging if you see the UK financial authorities blocking a very large deal?
Well, that's certainly what the folks were saying yesterday, that it was terrible, and clearly London didn't want growth, and it seemed a very partisan and quite emotional statement in my view, at least. Of course, all these things feed into people's decisions about where they're going to list, and yesterday there were several senior city people who gave evidence to Parliament about this issue. And what they said time and time again is you have to have different things that are changed in order to improve the whole ecosystem. So it really can't just be about straightforwardly folks get paid more money in the US, or there's a higher valuation on the stock. Those come from other factors. So there's a higher valuation on the stock because there's more liquidity in the US. We need to bring that liquidity into the UK market. One of the things that comes across time and time again is how you harness the huge pensions industry we have here into being more effective investors in UK companies.
If I'm not mistaken, you both wrote a piece on this, is that right? Okay, we have the perfect two people to talk about that. Well, what will it take to get what the folks you and Catherine spoke with about getting that money into London? What does it take in terms of regulation or investment?
I was struck yesterday a bit by the fact that these three sort of senior city figures speaking in Parliament seem to be much better at identifying and analysing the problem than suggesting like any obvious solution. I mean, in order to make a change like this, you need Parliament to give new powers to the Financial Conduct Authority in order to assist with that.
Okay. So just to wrap things up, and Catherine, I feel like this is an impossible question, but you touched on this a bit. What are sort of the next crises that regulators have their eyes on? What is it the next thing that they're thinking about tackling, or is it just taking care of the problems we've seen over the past month?
Yeah, that is an impossible question, and as everyone always says, I'd be a hedge fund manager if I knew the answer. I mean, there are certain sort of, flashing lights in the economy which are easier to identify. So some of the US banks talked about commercial real estate being potentially quite a problem. The US debt ceiling is obviously causing huge drama across the world. But really that more sort of philosophical point about what's the nature of the next crisis is very difficult. I don't think anyone really would have identified the SVB crisis particularly, although as we started this discussion, UK regulators did in fact see the sort of concentration risk and some of those issues around this particular group of customers. But I do think this new world of instantaneous withdrawals of deposits creates a real problem across the board. So whatever the actual pressure point turns out to be, it's this point about if we want a world where we have fractional banking, where you believe in people being able to put their money into banks and take it out whenever they like, you've got to deal with the fact that people can do that in an instant now, and that's a very new thing.
It's so true. Hey, Catherine, Will, thank you both so much for joining this morning. Really fascinating conversation. That's Catherine Griffiths, our city editor, and William Shaw from Bloomberg's finance team. And be sure to subscribe to Bloomberg's In the City podcast on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Coming up, is the game over? The UK puts Microsoft's $69 billion takeover of Activision Blizzard in jeopardy after blocking the deal. We'll discuss that next. This is Bloomberg.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here we shoot for singles and doubles, and we definitely never want to strike out.
Economics, finance, politics. This is Bloomberg UK. I'm Danny Berger in London. UK regulators have blocked Microsoft's $69 billion purchase of Activision Blizzard over concerns it would harm cloud gaming competition. The companies plan to appeal the decision as they try to salvage the biggest ever deal in gaming. With us now is Bloomberg.
Is cloud gaming, often subscription-based, where you might pay clearly a certain amount every month, and you get through that access to a whole bunch of different games. It's something that Microsoft has been quite bullish about. It's sort of a medium to long-term play built on Azure, on their cloud. I suspect, therefore, that what's happening with regulators is they are trying to ensure they avoid the mistakes of the past. When Facebook bought WhatsApp, when Facebook bought Instagram, they weren't necessarily massive competitors to Facebook. But in hindsight, regulators suspect maybe they could have become competitors. Similar with Google and DoubleClick. So what they're doing is making a decision early in this race to try to prevent market concentration.
But why is this a fear? I mean, can't Microsoft just say, all right, it won't just be available to download on our cloud store. Other gaming companies can do this too. Why are regulators picking on this?
So one of the concessions that Microsoft offered was to make it available for a certain number of years, make things like Call of Duty, which is made by Activision Blizzard, available for a certain number of years to its competitors in the cloud. The challenge with that is what happens after a certain number of years, often sort of 5 years, goes quicker than people will imagine. And secondly, it's something that the regulator will need to keep an eye on, right? It requires further regulation, which is a bit of a burden they don't necessarily want to take on.
So what next? Can they successfully appeal this?
Well, they can appeal. Whether they can successfully appeal is the big question. There's not a great track record of companies appealing CMA decisions. The other thing, of course, is we're yet to hear from US or European regulators. There's a possibility they might take a similar tack, in which case it would render perhaps an appeal in Europe, sorry, in the UK, sort of moot if the decision across the board is to block this.
Yeah, Chris Hughes has a really good opinion piece where he says something like, you know, think again if you want to do M&A in Britain. So it's interesting to think also about the chilling effect perhaps on M&A in this country as well and regulation there. Alex, thank you so much for joining us. That is Bloomberg's Alex Webb. Now later today on the European Close, we're going to be hearing from the CEO of Activision Blizzard. That's Bobby Kotick. That's going to be at 4 p.m. UK time, 11 a.m. New York. Well, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Anna Edwards. This is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bank earnings have actually been quite solid. Deposit flows have steadied quite a bit. I don't think that this is really a crisis of confidence, but I do think it's likely that we continue to see some jitters, especially around some of these names.
Ultimately, it's not systemic in terms of a major run on the bank. The bigger question is, what does this do in terms of financial conditions more broadly?
Higher interest rates are going to slow things down. If we see credit tightening on top of this because of what's happened in the banking sector recently, I think that all points to a recession.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Meta buys itself some time. A surprising digital ad sales rebound will let the Facebook parent keep pouring money into artificial intelligence and virtual reality. First Republic's standoff, it's stuck between U.S. regulators and its largest rivals, both of whom hope the other steps in to save the troubled regional bank. And two of Europe's biggest banks report earnings. Deutsche Bank is ramping up cost cuts, while Barclays rises after beating expectations. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, once again, we see this push and pull between sentiment from the banking sector and sentiment on tech. For the moment, U.S. futures pointing higher on the latter of those, on the tech themes.
Yeah, that's right. And we really have seen that divergence boost the NASDAQ, for example, yesterday in the cash trade, while the S&P falls. So tech really a big part of this trade. But yes, the First Republic concerns are really weighing on the market. Right now, the S&P futures are up about 0.5%, and you do see 10-year yields coming up a little bit. That means that investors are selling that debt at 347.30. We're about 7 basis points higher than we were at the same time yesterday. NYMEX crude, on the other hand, has come down pretty substantially. We're up 14 cents in the session, but yesterday, remember, we were looking at $77, $78, and now we're looking at $74.44. So real concerns about the demand side of the equation outweighing any kind of supply constraints that OPEC Plus and others can put on. Bitcoin continues to rise closer to $30,000. We're almost at 29 again, 28,970, up another $550 or 2% today. Of course, it's heavily correlated to the tech side of things. So when you have Microsoft doing well, when you have Meta doing well, you get a pickup in Bitcoin as well. Take a look at what's going on in Asia. In terms of the broader market, you had a slight gain, 0.1%. Chinese stocks are doing a lot better, though, than the other indexes in the region. The CSI 300 up about 0.75%. I wanted to include Samsung here because They came out with earnings that disappointed for the current quarter, but an outlook that was more upbeat. So the shares initially fell in the session more than 1%, and they have come back to the close about 0.8% higher. So obviously this is going to be connected to chip stocks in the U.S. and in Europe as well, in the U.K. as well. And then the yen, right now not doing a lot at 133.87. The dollar sees a little bit of strength against the Japanese currency. But the Bank of Japan kicked off its first meeting under its new governor, Ueda, and tomorrow we'll actually get the decision. So watch this pair as well as the yen paired against any others. What do you see going on in Europe, Anna?
Yeah, well, here in Europe, Matt, we're dealing with that twin push and pull, as we mentioned, around technology and financial services, and also the earnings stories domestically, or at least European generated. Add that on top. So this is the picture in Europe, fairly positive, just into positive territory on some of these markets. The FTSE 100 entirely flat, but actually European markets eking out these gains after we saw losses earlier on. Earlier on in the trading day, we were much more weighed down by the nervousness around the banking sector over in the United States. We're managing to put that to one side. The technology story here in Europe, though, is more mixed, is more nuanced than maybe the mega cap story out of the likes of Meta would have us believe. This is the picture for ST Microelectronics, for example, Matt, and you went through the Samsung story there. That in itself was a little mixed. ST Micro down by 7.5%, even though the numbers came in better than expected. The company upgraded its guidance, but for many analysts, this wasn't new enough information about the company or the sector, and as a result, the stock has sold off. Barclays in the financial services space in London up by just over 4%. The numbers there, in particular from FIC Trading, they helped to offset, they were strong, they helped to offset some weakness in the equities trading side of the business and the M&A from fees and investment banking. There we saw, just like many other banks, that was a little lackluster. We'll get more on the Barclays story for you shortly. Unilever up by 1.3%. The fast-moving consumer goods business saw volumes at surprisingly high levels, despite the fact that prices are rising. Consumers are prepared to tolerate those higher prices, to pay up for them, and they're not seeing down trading into cheaper brands, which is interesting. Universal Music Group down by 3.9%. And what was interesting here is this is another story of a beat this morning, Matt, but another story of a beat that wasn't enough. So the numbers came through from Universal Music Group better than expected, but apparently it was a physical market rebounding, CDs in Japan and vinyl in Europe and the US, and analysts deemed that to be unsustainable, and as a result, the stock is weaker.
Yeah, it's interesting you're seeing kind of a mirror image there of what we've seen here, right? Because you have tech stocks down, ST Microelectronics off, and bank stocks up. Barclays and Deutsche Bank doing quite well. So at least for the time being, you've got a reversal of the push-pull that we have seen here. Let's take a look at big tech after Facebook reported, or Meta as the parent company is now called. Quarterly revenue and user growth both beat estimates. The company's surprising digital ad sales rebound is buying it time to keep pouring money into artificial intelligence, a real buzzword for this earnings season, and virtual reality, not so much. CEO Mark Zuckerberg spoke on generative AI on the earnings call.
I think that there's an opportunity to introduce AI agents to billions of people in ways that will be useful and meaningful. That's been a pretty amazing year of progress on this front, and the work happening now is going to impact every single one of our apps and services.
Bloomberg's Alex Webb joins us now for more. So, Alex, Facebook growing again after some cuts and controls on the cost side.
Yeah, that was really what has got investors excited. This has been heralded by the company as its year of efficiency. They've been cutting 17,000 jobs over the past few months. That has prompted a real resurgence in the share price. What we're seeing now is actually growth on the top line, and that means that it's good news on two fronts. It does give them some scope to invest in some new products, but it was also very interesting that we've seen a shift in the tone of the conversations. Talking a little bit less about the metaverse and a little bit more about AI.
Yes, that was interesting, wasn't it? So, and the insistence coming through from the management that they are still focused on the metaverse, and yet colleagues counting the number of minutes dedicated to talking about these things say that the call was much more focused on AI. What about the competitive environment? So, for example, against TikTok, I know that Meta's been all about Reels recently. How's all that going on?
Well, they're saying they saw a 25% increase in engagement on Instagram, which is clearly good news for Facebook. They are also prepping a new product that's being reported in some circles, which will compete more directly with Twitter in the hope of hoovering up some of the discontent Twitter users. Look, engagement on Instagram tends to keep people on the platform more than it does on Facebook. People are more likely to click out of Facebook to go to places elsewhere, so it can be quite lucrative. I think the bigger story than those product-specific things is just generally the uptick in ads. There was conversation yesterday around Google, Alphabet, the parent company of Google, that ads had seen a recovery at Google, but YouTube hadn't been as good. That caused a little bit of concern looking towards Facebook, that maybe, well, Facebook is more comparable to YouTube. What we've seen today or overnight is that that is not really the case, and that Facebook has been benefiting from the tailwind too.
All right, Alex, thanks very much. Alex Webb there, wrapping up the tech side of things for us. Let's get back over to the banks, because Deutsche Bank pledged to step up cost savings after its traders trailed Wall Street for a second straight quarter. The CFO, James von Moltke, spoke with Manus Krenny about the impact recent turmoil in the sector has had on DBK.
In the last couple of weeks of March, our view is perhaps 1%. We saw of that 4%, 1% in that period. Interestingly, once March was over and we were into April, like a light switch, the concerns around the banking industry went away, and we've seen deposits stabilize and grow over the course of April. I'd expect that we'd be back over 600 billion by the end of the month, and I think confidence has come back into the sector.
Manus joins us now then from Frankfurt. So Manus, what do we know from James von Moltke from Deutsche Bank? It looks like investors are pleased with the results.
Well, in the first sweeps, yes, Matt, and a very good day to you. What you're seeing is liquidity buffers being built at Deutsche Bank. An investment bank, however, which is down there at the lower echelons, down 19% on the quarter. But the core of Deutsche Bank, which is the retail banking arm, the corporate lender, is on fire. It's cranking it out there, over 30% growth in the quarter at the core bank. So the question that goes through my mind, are we at peak interest rates or near peak interest rates and peak NIMs? Peak investment bank, part of the huge turnaround story at Deutsche Bank. And when it comes to that narrative, he pushed back very clearly that he wouldn't think that that's the top or the peak in the turnaround in the Deutsche Bank story. On the flow show, 29 billion went out. 2/3 of that was normal, flipping into money market funds. And then, as he said, the light switch came on in April. Things calmed a little bit for them. 12 billion came in terms of asset gathering to the private bank and to wealth management. And you can be sure they're tapping on the doors of every wealthy family and client around Europe. It's one of those moments that will endure in this story. And they've changed the language on the buyback. They are now initiating discussions with regulators, and that's what the market has been banking on. A little bit cautious in the tonality. Maybe the Credit Suisse debacle and the UBS pausing on the dividend has given them cover to extend and pretend on when they deliver the buyback. Anna, Matt.
Yeah, the Deutsche Bank share price up by 2.3% then on that news. Manus, thank you very much. Manus Krenny in Frankfurt. From one bank to another, Barclays has beaten expectations in the first quarter with a surprise increase in fixed income revenue. That offset falls in equities trading and in deal making. Bloomberg's Francine Lacroix sat down with the CEO for an exclusive interview. He said he's confident for the next quarter despite the recent banking turmoil.
I think the Credit Suisse was a very specific case. While I think Silicon Valley Bank was a specific case in terms of its circumstances, it has highlighted an issue with some of the regional banks in the US. And that we will see continuing to play out maybe in a small number of names. And we've seen First Republic over the last couple of days. So I expect that we will see over a small number of names. It's not going to be systemic in any way, but there will be repercussions.
So not systemic is his verdict. Francine Lacroix joins us now with more. Francine, good morning. So a good set of results then from Barclays, judging by the share price reaction. FIC traders doing what they're paid for. Can they keep up that momentum?
Yeah, so we really asked him multiple times to see whether this is a trend that he thinks will continue. Now, he says, look, it's not really a hedge because they've tried to build the business, and he took immense pride in saying these set of results were also some of the changes that they put in place over the last 18 months or so. So he says, look, FIC trading, which is a big part of what what they do. Equities is appointed not a huge part of what they do, will be there as a buffer. So I don't know if it's a natural trade, but he really wants to work on all of the levers, all of the drivers going forward to make sure that whatever the economy throws at him, this could be either a credit crunch or a consumer, although he was pretty confident that they will hold because he's already seeing a pattern of changing behaviors, that they can, change that and put money where it needs to be. It was also really interesting to get him on deposits. So he said he saw about $10 billion in deposits in the quarter, and that's also because of a change, I guess, because of SVB.
I thought you made a great point about the importance of diversity, and he backed that up. I also thought it was really interesting, Francine, his view on working from home. He's been working from home as he battled cancer, and now he's come back to the office. And I thought his take on the consumer was really fascinating, that the consumer is really pulling back, but not really suffering, still doing quite well.
Yeah, and you're right, Matt. Good morning. I mean, it was really actually quite touching to see so much energy from someone who's been through a lot. He's never actually stopped working, but he says he wasn't really working at full capacity like he's now. When he talked about the hybrid working model, he says, look, he had to work from home because of his illness for many months. And he says it's a very different perspective where everyone else is in the office. So he really, and you could see it was palpable, the energy that he had from meeting with his team and kind of meeting in person. On consumers, he did see, Matt, there was a change in consumer behavior, certainly here in the UK. Nothing huge, but actually he says there's more savings, and people, of course, trying to save money also by trading down in what they spend. If you look at Barclaycard, it really gives you a good sense of what the consumer does in I guess the next month or so. And he says for the moment there are headwinds, but consumer spending remains pretty strong.
All right, Francine, fantastic interview. I recommend anyone who didn't see that go to Bloomberg.com and check it out. Francine Lacqua, an exclusive interview with the Barclays CEO, Venkat Krishnan. We're going to show that, a little more of that later on this hour and throughout the day. Now, First Republic, speaking of banks, but focusing more on smaller regional banks in the U.S., the stock was halted 16 times during yesterday's trade as the price continued to drop. U.S. regulators are said to be weighing limiting the bank's access to borrowing from the Fed. Bloomberg's Valerie Teitel joins us now for more. So, Valerie, is there any sign of a rescue deal for First Republic, either from regulators or from the big banks that deposited $30 billion with this regional bank?
Yeah, is it going to be a private or public rescue deal? It seems we're just waiting for another big bank to come in and swoop up First Republic's assets. And it's more likely to happen the lower the share price goes, that some bank out there will find value in their assets. But they've been struggling to find a buyer for weeks. And possibly a potential bidder is just hesitant because they want the government involved in order to protect them from some potential losses in the loan book. But the regulator from the FDIC, they seem in no rush to put the bank in receivership. They don't want to do that because they want to avoid taking yet another loss to their insurance fund, and they really want a private rescue instead. So it's become a bit of a standoff between the FDIC and the wider banking industry.
Yeah, I really recommend Matt Levine's piece on the Bloomberg Terminal talking about what it means for various players in the sector, regulators and other banks, depending on how this is resolved. The other risk that the market is weighing up then, Valerie, is really around the U.S. debt ceiling drama. What's the latest on the deadline?
Yeah, just another potential growth that the market and the Fed has to deal with when they meet next week. Now, there's been a sudden acceleration in tax receipts. This means that the recent approximation for the X-date, for the date of default, has been pushed out to late July, possibly early August. Now, we should hear from the Treasury some point, maybe later this week, maybe next week, on what their official assumption is for the X-date. Now, earlier, before this recent acceleration in tax receipts, we thought the date could be early June. Now, is more time a good thing or a bad thing? It's really not clear, but for the markets, it's just another risk event looming large that they would rather be over.
All right, Valerie, thanks very much. Bloomberg's Valerie Teitel talking to us about really the most important stories for the market today. Meanwhile, there is no sign of any compromise in the partisan battle in Washington, D.C. over extending the debt limit, something that really hasn't hit the markets too hard just yet. House Speaker Kevin McCarthy's debt limit bill has squeaked through, but that's put pressure on President Biden to open talks with the GOP to avoid a payment default this summer. But But the president has signaled he won't give in to Republican demands. McCarthy spoke after the bill passed.
Now he should sit down and negotiate. We passed this early. We are in April, way ahead of the debt limit. We just passed the bill. It's not our job to modify it. The Senate could pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
That's the latest on the debt ceiling then stateside. Coming up on the program, Skylar Montgomery-Koning joins us, Senior Global Macro Strategist at TS Lombard. What does she make of the rates environment right now? How does weakness in the regional banking sector in the United States weigh in onto the Fed conversation about where rates go? What does that mean for bond markets? We'll discuss all of that. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question its industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York with Anna Edwards over in London, and we are waiting for some inflation data here in the U.S. On a number of fronts, CPI as well as ECI, and some things that the Fed looks very closely at. In the past few months, when we've gotten this data, you see a ton of volatility before the number comes out, and now we see that happening less. Of course, April has seen far less volatility, but we've got a new gauge. The VIX one-day gauge is what we're looking at here. Joining us to talk more about it is Noor Al-Ali, Bloomberg Markets Live editor. Noor, we look at this and we're excited about it because a lot of people think the VIX is broken, and many investors have gone to 0 days to expiry options instead to hedge.
Yeah, absolutely, Matt. And you're absolutely correct. I think, and I talked about this a few days ago on the blog, what it really implies or it shows that there's a structural shift in the market. We had some data that showed about 40% of the S&P 500 options have actually shifted to the 0 day options. And that really is a reflection. I mean, even if you have the VIX, if you look at it from a short-term volatility as well, you look at the 9 day, you'll also see that trend there. But it really, what it shows us as well is that perhaps there's much more risk priced into the market than investors are seeing.
Okay, and take us to the yield curve as well, Noor, because I know that you've been writing about this recently, talking about the yield curve steepening, and some in the market seeing room for it to steepen further if we're going to see, short-end rates coming down to reflect an expectation of cuts? Is that what what people anticipate.
Absolutely. And look, historical performance, I mean, this is the caveat, is not a reflection of future performance, but we can look at trends and we can infer that in the last, I've got like maybe some 3 examples today that I've talked about in the blog here. You look at it in the 1970s, you look at it in the late 1990s, and even in the 2008 financial crisis, and you'll see that there is often a re-steepening of the yield curve, particularly after an inversion that comes in ahead of a Fed interest rate cut. And obviously, a lot of people talk about, well, that is a greater indication for a recession, and that's what we're looking at when we're talking about the yield curve.
Okay, we're alert to that. Thanks very much, Nora Ali of the Bloomberg Markets Live team. She mentioned the blog. You can find that at MLIV Go. That is the Market Live blog, available on the Bloomberg terminal. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Coming up, Skylar Montgomery Koenig, Senior Global Macro Strategist at TS Lombard, joins us, and there's a lot to talk about. As Anna said, there's really a push and pull between concerns about the banking sector and optimism for big tech. This is Bloomberg.
what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Meta buys itself some time. A surprising digital ad sales rebound will let the Facebook parent keep pouring money into artificial intelligence and virtual reality. First Republic's standoff, it's stuck between US regulators and its largest rivals, both of whom hope the other steps in to save the troubled regional bank. And two of Europe's biggest banks report earnings. Deutsche Bank is ramping up cost cuts, while Barclays rises after beating expectations. I'm Anna Edwards in London with Matt Miller in New York, and the focus here in terms of banking is on the banks reporting, and all of that, so far so good, seems to be going pretty well for the banks that are reported today, Matt. The focus for you guys in terms of banking still on those regionals, and we thought we'd left that topic behind in March, but it seems it's back with us.
It's come roaring back, right? I mean, Ben Emmons over at New Edge Wealth writes about FA flight, so financial advisor flight, and that's a new thing that First Republic has to worry about as we wait to see who rescues them, right? Is it going to be a public or a private rescue? I think it's really interesting. Right now, we're looking at S&P futures that are gaining, but this kind of push and pull that you've highlighted is what we've seen over the past few days in this market. Tech stocks doing really well after reporting good earnings, and as a result, by the way, NASDAQ futures are up even more. I don't have them here, but they're up 0.8% right now. And bank stocks and really financial services doing poorly. And you've got that split in Europe as well, right? Because the banks are up, financial services are down. The U.S. 10-year yield is just barely moving higher in today's session, but we're up 5 or 6 basis points from where we were at this time yesterday. Right now, 345.60. That doesn't seem like it's going to be enough to give stocks a run for their money, and it does seem like if investors are letting go of the 10-year and of U.S. debt, of zero risk debt, that they're willing to go into stocks. NYMEX crude is rising 19 cents. WTI, though, yesterday was at $77, $78. So now we have a 74 handle on WTI, and the same is true for Brent. It moved down in yesterday's session and is recovering up a little bit today. This is because of concern for demand. It hasn't really shown itself, and the supply constraints that OPEC Plus have come on aren't helping to move the price much higher. Something we talked a little bit about to Fatih Birol yesterday. And then Bitcoin up $500. Obviously, it's highly correlated to the tech stocks that are doing so well, but it's climbing back towards 30,000 after dipping below 27 briefly. It's at $28,928. Take a look at some of the movers in the market. Meta obviously is going to be a huge one. It's poised to add $61 billion of market cap if we see it gain by 11% in the cash trade. And by the way, analysts love this stock now. It has 46 buys and only 5 sell ratings, as well as an average price target of over $250, right? And the stock is up 74% year to date. Mark Zuckerberg has kind of turned the page, and he's now focused on cutting costs and generating profits, and that's what the market wants to see. Snap is also up about 3.6% in the pre-market. It reports later today, but we've seen great stuff from other tech companies, so we're waiting to see what we get from this. I think of it as kind of a kids app, but of course the kids that use Snap are millennials and now like approaching their 40s. First Republic is the problem child of U.S. regional banks, and it has been absolutely crushed over the past couple of trading sessions again. This is a bank that traded for $175 just a few months ago, and now it's trading for $585. Real concern about obviously deposit flight. We learned of $100 billion leaving First Republic out of only 173 to begin with in the first quarter, and now we're talking about financial advisors just taking their whole business, clients' money, and leaving. So that's a problem. Stellantis is doing well right now, up 1.6%. The maker of the Dodge Challenger Hellcat is cutting costs. It's offering buyouts to 33,500 U.S. hourly and salary employees. Of course, it's going to move on from the 6.4-liter Hemis to battery-powered cars, which take far less, which require far fewer people to put together. And then Wolfspeed is a maker of semiconductor products. It's down 14% in the pre-market. It used to be called CREE, C-R-E-E. It forecasts revenue in the fiscal fourth quarter, which is this current quarter, that missed analyst estimates. And people are watching chips so closely, Anna, so this is a key one to watch. What do you see in Europe?
Yes. Yeah, well, one of the things we see in Europe is what you pointed out last time we checked the markets, Matt, which was the sort of opposite push and pull to the United States. So whereas you've got tech going higher on the likes of Meta, we've got tech coming down because of that concern around chips. And here's the ST Microelectronics story supporting that, down by 7.5% or so. And the numbers were better than expected, but it seems that the guidance, even though they upgraded their guidance, it wasn't new information for the market. And so some decided to take some profits there. We also see the opposite trade to you in terms of banks. The story in the US around banking is focused on the regionals. There's concern there in particular. How ring-fenced is that? How idiosyncratic is that to one particular part of the regional banking space? Well, here in Europe, the focus is on big banks, the reporting season. That's going pretty well. Certainly fixed income traders doing well at Barclays, pushing up that share price up by 4.5%. That leads to this overall picture of not moving anywhere very fast, up by 0.2% this Thursday as we digest a lot of earnings reports here in Europe. It has been a really busy morning for earnings. And another one of those earnings stories is Unilever, up by 1.7% for the consumer goods product business, and they've managed to push up their volumes more than the market had expected. So even though prices are going higher, consumers are paying up for those, it seems, and consumers are not trading down, according to the CEO, to cheaper brands. That's one of the observations that he gave us this morning.
All right, let's talk about all of this with Skylar Montgomery-Koenig. She is a senior global macro strategist at TS Lombard. And Skylar, you know, before we get to the success, the optimism around big tech this earnings season, I want to talk to you about the bank turmoil. I won't use the word crisis, but the turmoil we've seen here in the U.S. We thought it was in the rear view mirror. Now we see problems again with First Republic and some other share prices moving in sympathy. Is this idiosyncratic? Is this a First Republic specific problem, or are you concerned about banking in the U.S.?
I mean, I will say when the crisis first happened, we did say it wasn't systemic, and I think that's still the view. But I'll also say that the SVB drama, it's made investors more aware of banks' funding and asset credit risk. So with the current market panic dealt with, for a large part, I think, these risks, they will take longer to become fully visible. It's more of a slow burn on bank profit margins. And a point to note is that bank funding costs are now set to rise. So depositors now have a better alternative with higher yields in money market funds and short-term interest rates. And competition for deposits, that will pose risk of outflows at banks that are too slow to raise deposit rates. And that makes potential liquidity events more likely. And that higher deposit, you know, that cost squeezes margins. There's also now a focus on exposure to highly interest rate sensitive sectors like tech and commercial real estate, And the credit tightening that is coming, that will weigh more heavily on these industries. So, finally, I think banks, they're a highly cyclical sector, so slowing global growth also weighs. So maybe not a systemic risk, more idiosyncratic to First Republic, but definitely banks are under more pressure than previously.
Skylar, I wonder how much, how closely is the Fed watching this? Because everyone kind of expects one more increase and then a pause, but I don't see any reason for a pause, right? They haven't beaten inflation yet, and they haven't really broken anything. We've had, idiosyncratic, as you pointed out, issues with certain banks that raise issues, but it's not like financial stability is in question yet. So how does the Fed play this?
Yeah, I think I actually have to disagree with you there in terms of, I think the Fed now, they're truly data dependent. The next meeting will likely get a 25 basis point hike because a lot of the angst has come out of the market. But the SVB crisis, that's doing some of the tightening for them. Unfortunately, though, that tightening impact is unknown, and it's likely to be more volatile than just another 25 basis point hike from the Fed. And I think the market focus now, it's very much on, the magnitude of cuts in 2023 and 2024. And the market's able to focus on cuts because the key is that inflation peaked in the summer. And it's been declining since then. So inflation surprises are actually negative now for the first time since 2020. Inflation's falling, and the financial turbulence has given them room to not guide higher. They're still trying unsuccessfully to convince the market of higher for longer. But, I agree with the market that the Fed will be forced to cut, and our expectations are actually more dovish than the market. So we think that the Fed will cut to 2.75% by the end of 2023. We're on the path to recession, and usually when the economy enters a recession, it happens quite quickly. The move tends to be non-linear. When the economy goes into a recession, the Fed historically cuts quite deeply. But even, what's more is that as inflation falls, if the Fed does nothing, they actually are doing higher for longer. They're engaging increasingly high real Fed funds and tightening. And I just don't think that happens with unemployment rising.
Okay, well, if we do get to cuts quicker, then I don't know, is that good for the tech sector? It certainly, higher rates wasn't great for the tech sector, but somehow it managed to turn sentiment around when we all started worrying about the banking sector. The tech sector started to have a good time of things. Right now, Skylar, we're dealing with these very contrasting themes within tech. There's the sort of mega tech in the US where things seem to be pleasing to investors, and those stocks go higher. But there's a lot of concern around the chip space here in Europe, in Asia, and elsewhere. How do you pull these things together?
Yeah, I think we're seeing a natural rotation this year versus last year. So last year was the year where we saw higher rates. That meant that, what's considered typically duration didn't do very well, and tech was included in that. And so now we're not only seeing what was underperforming last year, outperforming this year, but also because the market is seeing cuts and it's seeing the peak in the policy rate that we'll certainly get this year, even if you debate, when exactly we get that peak and how many cuts you get after. We're certainly getting that peak in cuts at some point this year, and so that's seen as being more positive for these sectors. I think, generally, I actually think the risk asset resilience is justified, even though I see this recession and the cuts coming. And I think part of that is because liquidity has turned more positive. So if you look at the central bank liquidity impulse on a 6-month basis, that's turned more positive. You've had economic resilience, and all of this is feeding into these sectors. And naturally, you're going to see it flow into tech because it's the largest component of the S&P.
Yes, and therefore it maybe sets the pace. So maybe that answers my next question, Skylar, which was where do stocks in general go when we see the US go into recession, when we see the Fed to start cutting rates? What is the timing of those and the stock market moves?
Yeah, so I think, equities, as I said, they've been holding up very well. Part of that is that the end of the Fed tightening cycle in sight. And, what we saw in the market was the initial panic over SVB and the banking crisis. Then the market realized that there wasn't a huge amount of contagion. It wasn't a systemic banking crisis, and you have some of that over-exuberance undo. But, the biggest read-through to the U.S. economy was that the risk of a hard landing had risen, and that meant Fed cuts. So you got a massive rotation into these sectors. We've also gotten, this recessionary impulse increase, and I think now equities are starting to come around to this idea that the bad news is bad news, and that credit conditions are tightening to the detriment of the economy. And I think that makes sense. So that's why you're kind of stuck without being able to go higher or lower because, historically, you've never had a bottom in the equity market without the corresponding recession begin. Now, this is one of the most anticipated recessions in history, and so you could argue that it was well priced in beforehand because the recession is essentially being caused by the Fed. But I think we're caught between these two counteracting factors, and so we're actually neutral equities, and I think it makes sense. Equities are also very dependent on nominal growth and earnings, especially when you don't have easy money. So investors, they could look through a mild recession.
Skylar, thank you so much. Thanks for your time. Skylar Montgomery Koning of TS Lombard, thank you very much for joining us. Coming up on the program, Meta's earnings beat. It sets the stage for more tech results due later today. More on the tech sector next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I continue to believe that slowing hiring, flattening our management structure, increasing the percent of our company that is technical, and more rigorously prioritizing projects will improve the speed and quality of our work. I also believe that a stronger financial position will enable us to weather a volatile environment while remaining focused on our longer-term priorities.
Mark Zuckerberg there, of course, the CEO of Facebook parent Meta, speaking after the company reported quarterly revenue and user growth that beat estimates. Joining us now is Bloomberg intelligence analyst Matt Bloxham. Matt, let's dive deeper then into the numbers that we got through here, and where the surprise came from. The positive surprise was really on revenues, on ad revenues. What's the driver there? Does it tell us anything broader than just Meta? Is also an interesting thing to think about.
It probably does, but I think more specifically, it really is a kind of Meta recovery story. They spent all of last year struggling with rivalry from TikTok and adjusting to Apple's changes in privacy, which really hit their ads business hard. So I think this quarter is a very clear signal that we've got things back under control and we're starting to get good momentum again. I mean, revenues only grew about 2.5%, but after 3 quarters of decline, that was a good turnaround. And I think it's the Reels product, which is their short-form video product, which has started to get better traction. It's helping viewing time on Instagram, and they're getting better monetization against that. It's still not monetizing as well as their legacy products, but it's on track to get there maybe next year. So I think encouraging signs that things are back under control in the part of the business that makes all the money.
It's so weird that Vine turns out to be the killer app that makes money for Facebook. I wouldn't have believed it 10 years ago, and I still don't get it. But how does AI play into their strategy? I mean, everyone's mentioning it. Everyone has to talk about it. I feel like you know, every CEO's flack makes sure that there's a paragraph about AI in the earnings release. But what does it do for Facebook, for Instagram?
Yeah, and same for Facebook. You know, they spent 90 seconds talking about the metaverse and 6 minutes on AI. Amazing. So I think for them, it's kind of at the moment sitting in a bit in the background. And the way Mark Zuckerberg described it is that AI is helping them to serve the right content to their audience at the right time. That means they're getting better engagement, and it means that they're getting better traction in terms of the ads that they're serving, and so brands will want to spend more with them because they know they're going to get a better return on it. So at the moment, it's just kind of helping the business be more effective and efficient. We might see them put things into the front end. You know, Mark Zuckerberg said AI is applicable to all of their products. This morning on Snap, I got a new friend, if you like, which is an AI chatbot that they've just launched. So I'm expecting to see something similar on Instagram or WhatsApp maybe sometime soon.
Okay, do let us know how that friendship develops, Matt. We'd be interested to know. We heard from the CEO, we heard from Mark Zuckerberg talking about the prioritization of projects.
Yeah.
Is the management's vision aligned with the street right now or not? Or is it just that because of the uptick in ad revenue, the street's going to make less fuss about a misalignment of visions?
Yeah, I think that's probably, you know, they're still very clearly committed to the metaverse as their North Star. I mean, the losses this quarter were close to $4 billion of their investment in Reality Labs. So I think there is a big mismatch there still. And I think, you know, the street's patience with those heavy losses isn't going to last that long. But yeah, it's an easiest pill to swallow when the core ads business is performing respectably.
Okay, Matt, thanks so much. Thanks for bringing us the analysis. Matt Bloxham of Bloomberg Intelligence. Coming up on the programme, Barclays bond traders helped drive the bank to a profit beat, helped drive the share price higher. We'll bring you part of our exclusive interview with the company's CEO next. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. On to banking, and Barclays traders surpassed expectations in the first quarter with a surprise increase in fixed income revenue. The bank's CEO spoke exclusively to Bloomberg's Francine Lacroix.
It was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling, it's about up 16%, revenues up around 11%, 7.2 billion pounds, an excellent ROTE of 15% across the group, capital ending where we would like it to be, one of the, a record quarter of performance for the bank, and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are two parts I'd like to highlight. The first is the investments which we've made in our business. Whether it's in our credit card portfolios in the US, where we acquired a Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIC trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets, and that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers, and that at the right times in the market, that they all are there and they click. So, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US. The first quarter a year ago was about equity vol and single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about 10 billion pounds during the quarter. And a lot of that was actually corporates putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably, but it's also, for us, it's a deposit franchise that we've built over decades, right, with a very nice mixture of individuals, of corporates, small businesses.
An exclusive interview there with CS Venkatakrishnan talking to our colleague Francine Lacroix. And interesting that he doesn't see the US banking turmoil matter systemic.
Yeah, I mean, of course, it's good that he says that for the whole industry, right? If he did see it as systemic, his share price might not be doing nearly as well right now. But I thought it was also really interesting, his take on the consumer, which started out this interest rate hiking cycle much richer and is now not nearly as damaged as it could have been otherwise.
Yeah, no signs of distress. One of the ways he characterized the UK consumer right now, and he has great insight into that. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.
most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy. But
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Quite frankly, I love this model right now. The bigger question is, what does this do in terms of financial conditions more broadly?
Basically, every traditional leading indicator of recessions is flashing red.
I think we are on a slow bleed into the recession. The odds firmly favor the U.S. economy being in recession in the third quarter of this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Facebook's like, what recession? What recession? From New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.5% on the S&P 500. The focus on several things. A debt ceiling deal with the Republicans in the House. We can talk about that a little bit later. A big win for Speaker McCarthy. Shaping up a bit of a face-off with the President of the United States. We'll pick up on that a little bit later. We need to start with the tech results, though. Meta, Facebook, getting it done. They call it the year of efficiency. I wasn't expecting the year of growth. That stock is up by more than 11% in the pre-market. TK, Mark Zuckerberg, putting out some good results.
You say to yourself, what's new here? When I'm including Amazon today and on to Apple May 4th, and what's new here is cost control. These are the fancy guys of Silicon Valley. They've never been through this, and I don't know who they're learning it from. Maybe it's Bob Dahl. They're dialing 1-800-BOB-DAHL and saying, Bob, how do we cut costs? I don't know, but the answer is that's the story. They're learning how to be prudent, how to
trying
cut
to do
costs.
more with less.
It's a prudent Zuckerberg.
A prudent Zuckerberg.
Yeah.
That's the year so far. At least we've had a rally of more than 70%. As I say, the new element of this, the new ingredient, a rebound in growth in the ad business.
And not just that, but also growth with respect to the user base. I was struck by the fact that 3 billion people every day on average, a new milestone, use Meta's products, including Facebook, Instagram, and WhatsApp. 3 billion people. That is shocking. So when people call for the death of Meta, not exactly the case. And to boot, they mentioned artificial intelligence, so easy win.
Yeah, that gets you an extra $1 in the pre-market. On course to be the best performing stock on the S&P 500 by the end of today, potentially. This stock right now in the pre-market through 230 in the pre-market. That's Meta, Facebook. We'll talk about Amazon reporting after the close a little bit later. Tom, we have to touch on First Republic.
Yeah.
What a struggle. A struggling financial institution looking for a solution. That stock with the smallest of bounce, Tom, up 3%.
In the last 24 hours, the sell side, and I give great credit to all of the financial media because of the lack of transparency here, the lack of discussion of showing the optionality forward for the government and for the other banks, the big banks that gave them 30 large. Fine. I'm not hearing anything from their management, which I find just bizarre, including the conference call that they didn't attend. But there's just zero messaging I'm hearing from their management, and I just find that I'll talk to Gerard Cassidy about it. It'll be my lead question. It's borderline irresponsible.
That was part of the story. That's how we started the week. We did not start the week in a good way. You start the week, you get earnings, you do an earnings call, Lisa. We didn't take questions on that call. There was no Q&A. I think that really set the tone for the rest of the week.
And it's only getting worse as there's no clear path to get some sort of buyer of the assets without some guarantor, maybe the government. The government doesn't want to come in and step and make people whole. I will say, though, the tug of war here is that the fundamental picture for a lot of the companies that are reporting isn't that bad. And so the banks are sort of the other side of the tug of war, which is how much does that offset any potential upside surprise?
There's no clear path here because we're trying to do it not like we used to do it. We used to do it, they dial 1-800-government and say, you're out of business, let's move on and restructure. And, we got this modern touchy-feely where we're trying to figure out how to do this. No one, Jamie Dimon's not going to get hurt. And First Republic. I waved at the First Republic branch on Madison Avenue yesterday.
Hey, let's be clear.
Walked by and waved.
Some of the big banks been vilified since the financial crisis. You saw what happened to JP Morgan when they took over Bear, Tom. You saw how they were treated. They had to inherit all of those legal issues at the same time. Basically, we've told them time and time again, don't do this. And now we're going to turn around and say, yeah, can you do us a favor and take over a small bank?
Exactly, or take your $30 billion large and make part of it or all of it some form of equitization or warrants. Sure. I don't get it. I mean, I'll let Gillian Tan and our team explain it to me.
And Matthew Monk as well. This stock is up by about 2.8%. First Republic of the pre-market. Equity futures positive 0.5%. Lots of data a little bit later. Great guest with us around the table as well. So let's get straight to it. Equity's doing all right. Yields higher, Lisa, by a single basis point. Lower through the whole of the week so far on a 2-year. On a 10-year right now, 346.
It'll be interesting to see because of that bid into treasuries, whether we get the data that confirms it at 8:30 a.m. We get U.S. initial jobless claims and the first quarter GDP. A lot of people looking to the first quarter GDP as a potential telltale sign of recession or not. I'm more interested in initial jobless claims, to be honest, because do we see this ongoing tick up? We've seen that sort of grind higher over the past few weeks. Does that continue, giving a sense of some sort of weakening in the labor market? Aftermarket, we get the tech grind, continuing earnings from Amazon and Snap. Just to give you a sense, Amazon shares are up about 25%. It looks like nothing compared to Meta, and yet here we are. That is a pretty big gain. You also are seeing Snap shares up more than 10%. Interesting to see whether the advertising strength we saw at Meta continues into Snap. And with Amazon, the retail segment very much front and focus. And at 4:30 p.m., my favorite indicator, but I don't normally always point this out, it's the Fed's balance sheet data, how much has come in, but also discount window lending data from the Fed. This is the tug of war we're talking about with the banks on one side and tech earnings, particularly the ones that we've gotten being really strong. Which is going to tip the balance when it comes to risk sentiment?
Great.
John?
I mean, she's at the University of Chicago studying medieval law, and she never thought she'd be looking at the Fed balance sheet. It's 4 o'clock.
4:30 on a Thursday. Yes. Looking forward to it. Bob Dollars as well. He joins us now, the CIO at Crossmark Global Investments. Bob, good morning to you.
Howdy.
Let's look at the numbers so far. Double-digit price increases at Kimberly-Clark, Procter & Gamble, Coke, Pepsi, take your pick. Looking at the numbers from tech, cloud spending still pretty decent. Microsoft, ad spending, pretty decent. Meta. What recession?
Great question. It's the most anticipated one we know in history. I'm disappointed that full-year estimates for the S&P 500 are not going up after all this good news. Maybe they've stopped taking the numbers down, but they're not moving up. Estimates are still too high is what that points out. You give me more than I expect in the first quarter, I don't change my number. That means I'm taking something out of Q2, 3, and 4. The slowdown is still upon us. All those lead indicators pointing to slowdown/mild recession. I don't see how we escape it, and you've covered adequately the systemic risk in the financial system. Handicapping that is very difficult. But I want to come back also, John, to what you said earlier. McCarthy pulled a victory. Only losing 4 Republicans was pretty amazing. So now the burden is on the Democrats to come to the table and have a conversation. We'll see how that goes.
In our Ute, there was a Nifty 50. Now we've got the Nifty 5 as well. Can I hide out in the Bob Doll caution in big tech?
Yeah, that's certainly a way to do it, but with the multiples where they are, not just for tech, but you mentioned the soft drink and the staples companies. Coke and Pepsi, their multiples are in the mid-20s. I'm not sure that's a great deal. So the defensive areas, to include some of those tech names, have certainly had a bid, and they're getting expensive. And overall, I look at my screen and I see the S&P 500 PE ratio 20.5 on trailing, almost 19 on forward, and the numbers are probably too high. If interest rates and inflation were, 2, that's probably a good valuation, but I really struggle with where we are. So I'm not bearish. We paid that price last year, but I am cautious.
All right, as we point to the future, you mentioned McCarthy. So let's go there. Let's sit on that for a minute. Does that deal that we saw in the House, even though it has basically no chance of making it and seeing the light of day, does that give you confidence that the U.S. can avoid a debt ceiling enough to price that out as a potential tail risk?
I think, Lisa, it definitely increases the probability we get something done. Had that failed yesterday, we're kind of nowhere. Neither party has anything on the table. Now the Republicans, with an incredible victory, put it on the table, and the Democrats have to come back with some kind of conversation, which probably raises the probability we get something done in the 11th hour, the 12th hour, maybe the 13th hour.
You say they have to. See no indication overnight that they will do.
No, it never happens until it has to happen. We've seen that before. I don't think either party wants to be blamed for default or decline in the dollar because of a potential default. So all I'm saying is the onus is now on the Democrats to have a conversation.
Is it your impression of things that you think that the Democrats in this White House are looking to see some market pressure build to gain some leverage over Republicans? Is that what they're waiting for?
Very possible. A couple of folks in Congress have said that in the last 48 hours. Give us a smack in the face in the markets, and maybe we'll come to the table, sort of thing. So that could,
for a market participant, do you find that really frustrating?
Yes, very much.
It drives me. It drives me absolutely insane.
Yeah, I'm with you.
That politicians are willing
to let that happen,
to involve financial markets and use that as a position of leverage.
It's a little toy, isn't it?
Tom, don't you find that ridiculous? And I know we've been doing this for a long, long time, but I just find it so irresponsible that that's the direction of travel. And by the way, that's not a political statement. It's politicians on both sides of the aisle trying to play games with markets.
And you see in the First Republic, too, the key, I think it's an adverb, it may be an adjective, I flunked grammar, John, but the key word in every report on First Republic, which goes to the politics of the nation, is wealthy. The basic idea that everything to do with First Republic is wealthy clients, jumbo mortgages. We know the drill. But there's a huge politics in our day-to-day news grind in finance, and also in how the stock market's treated.
FRC trying to bounce up by 1.6%. Let's just finish there briefly, Bob. There is a fear, and we talked about some of the robust nature of the numbers, the earnings. We can pick several indicators about tech, financials, whatever. Looking forward, lead indicators are terrible. You look at First Republic right now, and there's a big debate at the moment. Is that a First Republic problem or a broader banking issue that's going to lead to some kind of credit crunch? Where are you giving the team on that now?
The systemic risks are always there. They're just a lot higher than usual right now. Remember, the Fed took rates from 0 to 4.75% in 12 months. There are consequences. It's not just, okay, Silicon Valley Bank and Signature, and we get up and dust ourselves off and ride off into the sunset. There are more consequences. Might it be another financial institution or two? Could be. My view is it will include a mild recession. Hopefully it's only mild.
Unbelievable to think that early March, Tom, First Republic was a triple-digit name.
Yes.
Then a double-digit stock. And later this week, a single-digit name.
And potentially bankrupt next week. And here's the issue, the sort of push-pull of private investors. Will they be willing to come in? And can the government bail out this bank if really the people who they're essentially bailing out are the big banks that contributed $30 billion of deposits to help keep this afloat on the behest of the government? What does that do to the next time they seek some sort of lifeline from the big banks?
I found it odd at the time. Do you remember we were asking, what is it about this institution that has led these big lenders in this country to deposit a large sum of money over there, TK?
I can't answer that. I've
Here
been
we
thinking
are.
about it. Well said, John.
We asked that question a few times when it happened.
You know where I stand on this, and you got to get the surveillance cork out because I'm not supposed to editorialize, and I'm not going to do it in front of Bob Dahl. I mean, it's just no way. I'll do it on the break.
The problem is,
it's a marketing scheme. Thank you.
Damned if they do, Damned if they don't.
How about that SNL crisis?
You got it.
Hey, Bob, good to see you. Bob, thanks for being with us. Appreciate it, sir. Thank you. Bob Dole of Crossmark. Your equity market positive, up 0.4%. Facebook rallying hard all year. And again this morning, it's on to Amazon a little bit later. Emily Rowland in the next hour.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy's debt limit bill has squeaked through, escalating a standoff with President Biden. McCarthy overcame dissent from fellow Republicans to pass his first big test. It will put pressure on the president to open talks with the GOP to avoid a payment default this summer. But the president signaled he won't give in to Republican demands. Bloomberg's learned that Germany is in talks to limit the export of chemicals to China that are used to manufacture semiconductors. Berlin wants to reduce its economic exposure to Beijing. Chancellor Olaf Scholz is trying to balance Germany's interests in China with national security and human rights concerns. Facebook parent Meta Platforms reported quarterly revenue and user growth that beat estimates. The company's surprising digital ad sales rebound is buying it time to keep pouring money into artificial intelligence and virtual reality. Shares of Meta are up 74% this year after a record 64% drop in 2022. In Turkey, illness is prompting President Recep Tayyip Erdogan to cancel a planned visit to a landmark nuclear project. Erdogan has remained out of public view since late Tuesday when he fell ill during a live TV interview. Next month, he faces his toughest election since taking power in 2003. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Today, the Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens today on Bloomberg.
From New York City,
From London, in Sydney,
From Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Earnings season is here.
we haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first
First quarter results, impressive.
Revenue beat is amazing.
with exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
While I think Silicon Valley Bank was a specific case in terms of its circumstances, it has highlighted an issue with some of the regional banks in the U.S. And that we will see continuing to play out maybe in a small number of names. And we've seen First Republic over the last couple of days. It's not going to be systemic in any way, but there will be repercussions.
CS Venkatakrishnan, the Barclays CEO, with some good things to say about Barclays, at least this morning. Bond trading getting it done. That was the surprise. The stock is up by more than 4% in London trading. More broadly, welcome to the program. Here's your equity market going into Amazon earnings after the close a little bit later, and US GDP this morning, 8:30 Eastern time. Yields unchanged on a 10-year, 345.79 in the FX market. Euro dollar unchanged too, 110.40, but new high for the year in yesterday's session. Intraday on euro dollar just south of 111. Yesterday came very, very close to a 111 handle. Looking at the equity market, positive by 0.4%. A little bit of a lift here. The Nasdaq, Tom, getting the tech earnings that maybe the Nasdaq bulls were looking for through the week so far.
And I think a nice statistic here. This from Doug Cass's morning note down in Florida. He's recovering from a presumed injury of Aaron Judge at third base last night. And I love what Doug says, John. It's narrower than I thought. He takes 7 big tech stocks out, and SPX is negative 2% for the year. And I just think that shows the idiocy as we go into Amazon this afternoon.
They've had some massive moves, and the big question coming into this is whether the earnings would validate those moves. To see Facebook, Meta, whatever you like, up as much as it is this morning by 11% in the pre-market, after already delivering gains of more than 70% for the year so far, Tom, to see a bounce like that after earnings is pretty impressive.
And the mass to move Microsoft the other day, I think, again, it's like sort of moving an aircraft carrier with a tugboat in New York Harbor. I mean, there's a lot going on here. This is an important conversation. All of us, either direct or indirect, are riveted by the bank opera days of our first republic. Joining us, Gerard Cassidy, with decades of experience in practice and the quiet of a management and boardroom where there are tough decisions to make. He's with RBC Capital Markets. Gerard, I've never seen anything like this. The lack of communication of the management team at First Republic, the conference call, non-event, and even their communicating of dialogue with the government and other more solvent bankers. Are you surprised by their silence?
Tom, thank you for having me on the program. And I would say that obviously there is at a critical stage right now. They're being advised by some very smart people. And I think it's a strategy that they've chosen. It's hard. I was surprised, as you put it out on their earnings call, that it was a 15-minute call. I think a better strategy matter would have been just to release the earnings and not, have that 15-minute call. So certainly talking to the public is not something that should be pursued, and they're not doing that. But hopefully they are talking to very high-level officials in the government at the Treasury and Federal Reserve to try to resolve this issue.
From the time of Bill Isaac, Robert McTeer, and others on other bank failures which you lived and died with, Gerard Cassidy, just very simply here, have the rules changed where the government doesn't have a function here like we were trained in school?
Tom, I think they've evolved. I think the government always has a function because it's a regulated industry. The government, as we all know, guarantees deposits up to $250,000 per account. So there's always going to be government involvement because the government's guaranteeing those deposits. But it has evolved and changed over the years, from even when Todd Conover was the OCC, head of the OCC back in the early 80s.
So what's the challenge for the U.S. right now? If they bail out FRC in some capacity, even if it's just guaranteeing the potential losses on their loan portfolio to facilitate a sale to a private buyer, they will essentially be bailing out the banks that they had come to the table and deposit $30 billion with First Republic. If they don't, this bank collapses and prolongs the story of regional bank weakness. Which is worse?
It's a really tough dilemma for them. They're stuck between a rock and a hard place, the FDIC and the Federal Reserve, because as you pointed out, Lisa, either choice is not very favorable. And so it's something that they have to weigh, which is going to have the least negative impact to the banking system and to the economy. And clearly, shareholders and bondholders in these situations, like we've seen with Silicon Valley and Signature, they, of course, don't get bailed out at all. But it's the depositors, and it's the depositors over the insurance limit is where the focus is, and that's where the debate is at this time.
Gerard, on a larger point here, we've seen this tug of war in markets, whether it's the tech giants that are reporting fantastic earnings and other discretionary companies, or then on the other side, there's this overhang of potential weakness in regional banks that could continue. Is that enough to offset the strength elsewhere? In other words, is what you're seeing not enough to give you confidence that they're going to materially provide the credit and the impulse that this economy needs right now?
The Fed has been very clear that they're in monetary tightening. Since April of 2022, deposits in the banking system are down almost $1 trillion. You might remember during QE, during the pandemic, the Fed's balance sheet went from just under $4 trillion to almost $9 trillion by the first quarter of 2022, creating over $3 trillion of deposits in our estimate to the banking system, and now they're taking them out. So I think the stimulus or monetary policy to stimulate the economy right now obviously is not there because they have to fight inflation. So inflation has to come down. Once that comes down, hopefully the Fed not only will stop raising short-term interest rates, but they could back off QT.
Jared, just a final question from me, maybe slightly unfair on First Republic, just to be really specific. Is there a real risk here they lose access to some of the Fed's funding vehicles?
There's a possibility of that. You never rule anything out. And so certainly in their public statements, they have indicated they still have access. They still have loans and securities to pledge. We have not heard anything official from the Federal Reserve saying that the window is closed to them. So from their public documents, they still have access there. But it is limited because there's only a limited amount of loans and security that are remaining that could be pledged for that type of borrowing.
Jared, from your perspective, what would lead regulators, officials to close that access to them?
What would lead it there is if they think the situation is so dire that it's best off to stop allowing them to have access to that source of funding, because it will cause less losses to either the FDIC or the Federal Reserve. That would be potentially one of the reasons for them doing it.
There's a feeling based on our reporting that maybe we're getting closer to that moment. Jared, thank you for being with us, sir. Thank you. Jared Cassidy of RBC Capital Markets on the financials at the moment. This just in from the team over at Wells Fargo, Chris Harvey leading this effort, saying the following: we still expect to see 3,700 on SPX, a 10% correction from the April 18th intraday high. Portfolios should be de-risked and expectations moderated, with macro risk looming large. Chris Harvey and Wells Fargo moments ago.
And his colleague Jay Bryson with Sarah House, they overlaid that with what I thought was the shock of yesterday, framing out a sub 1% GDP this morning. Stephen Stanley of Santander with a piercing note this morning of the makeup of American economic growth first quarter, which gets you to where Chris Harvey is.
GDP out a little bit later this morning, Lisa, then on to next week. Payroll's just around the corner. It's amazing, isn't it? All of a sudden, the Federal Reserve back on deck. Feels like last week we had the last Fed meeting, but here we are again, just around a corner, then on to payrolls.
Which is possibly more important than the Fed meeting, which they're going to say we don't really have an understanding, which is the reason why some of these peripheral data points, including employment cost index, which I believe comes out before the Fed meeting, as well as tomorrow what we get with PCE, is going to be really important. How much progress have we made in actually fighting inflation?
You're still looking forward on the calendar. I thought you were going to Baku.
The restart of Formula One.
This is, Lisa, this is amazing. These guys go like 200 miles an hour. There's no Thursday practice, no Friday practice. They just start Saturday, John, at full tilt.
I didn't know that. Is that what's happening? There's no practice.
It's
why
strange.
is there no practice for this race?
I'm dumb on this. You're the smart guy.
Well, no, you're in charge now. You're in the driving seat for
there's no Thursday, there's no Friday.
But
you've fallen in love with this sport, haven't you?
I'm loving it. Yeah,
Wow.
I got that. Well, who else in Formula One has a Nash Rambler in the garage?
Who else? Who has one?
No one. Trust me.
Okay.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The equity market just about positive this morning. Good morning to you all and welcome to the program on TV and radio. This is Bloomberg Surveillance. Equities up by 0.4% on the S&P 500. In the bond market, yields look like this. A 2-year, 10-year, 30-year. Yields basically unchanged. 395 on a 2-year, 345 on a 10-year, on a 30-year. Let's call this 372. Want to finish in the FX market, have a little look at the euro against the dollar, just below 111 yesterday, holding on to 110 right now at 110.37. Want to ultimately finish on this, though. This move in Meta is phenomenal. Year to date, before yesterday, up more than 70%. We add more weight to the rally, about $23 worth to be precise. 233 in the pre-market, up more than 11%. Zuckerberg's called this the year of efficiency. Go one step further after yesterday's results, Tom. A rebound in growth. The ad business looking decent, looking okay relative to what we were expecting.
No one's a bigger critic of this hagiography of managers and like the study of managers and the whole billionaires idiocy in that. But the great misjudge here was that this kid, and he's still, what was the movie out of Harvard, the Zuckerberg movie from years ago? I can't remember.
Social Network.
Social Network. We're all social network analyzing, and everybody got this wrong. This is a new Zuckerberg. Everybody got it wrong, including me.
A lot of analysts got Caterpillar wrong as well. Those numbers just crossed. The estimate was 382. EPS came in, Lisa, at 491. I know you're going to go through the rest of the numbers, but just to go through that headline again, the estimate for CAT for the first quarter adjusted EPS 382. Lisa, the number 491.
And how about this? Caterpillar returned $1 billion through dividends and share buybacks. So on the flip side, they're also delivering a lot of returns to their shareholders. This has been the interesting time when people are trying to reinvest in the physical world. This is what we need. Just to give you a sense of how this breaks down, the first quarter adjusted operating income was $3.34 billion. The estimate, $1 billion lower than that, $2.36 billion, just to give you a sense of how much they outperformed. Here's the issue. How much further can this go? Is this completely dependent on North America? Is this just reinvesting? And how much does this really hinge to the idea of food prices remaining high?
Beat on the top and bottom line. Just to give you the top line, revenue for the first quarter, $15.86 billion. The estimate 15.32. The stock in the pre-market, Tom, marginally higher in early trading, up by 0.8%.
9% dividend growth 5 years there, $4 billion free cash flow pre-pandemic, $7 billion plus free cash flow now. It's just a malaise. I mean, is all I see. I mean, we got to get to our wonderful guest here, but John, I'm getting exhausted by the gloom on these. Where's Bob Dole when we need him here now? They made 13% a year each year for the last 10 years, moving yellow things around, bulldozers and all that.
It's not a bad business, is it?
Yeah,
it's not.
Why don't we jump in here? I think this GDP call today is fascinating.
I agree. 8:30, yeah. Lisa went through the data points. Look out for claims as well. 2 hours away from US GDP. Wall Street out with a number of forecasts. JP Morgan at the top of the pack, looking for 2.6%. quarter-on-quarter growth. Jay Bryson, who we spoke to yesterday at the bottom of the pack, looking for 0.8%. Citi's Andrew Hollenhorst, looking for somewhere in between, looking for a print, Tom, of 2.3% a little bit later.
This is different, and this shows you folks the nuances of each house and each different character. We've talked to Andrew Hollenhorst particularly about an arch Fed call of which he and Citigroup absolutely nailed higher interest rates. But this morning we turn to the nation's growth. Andrew Hollenhorst is with Citigroup. Andrew, it's real simple. You look at Boeing, which we saw ex-aircraft dynamics and durable goods here in the last 48 hours, and you say simply, this is a Boeing GDP report. It is not a boring GDP report. You go positive, don't you?
Yeah, that's right, Tom. I think, you know, it's a great point that you bring up when you look at the shipments of durable goods, of capital goods, and we tend to try to look at core measures of these things. You say, let's take out the aircraft. Aircraft is real production. These shipments of aircraft will show up in GDP. So that there is something going on here. Now, I'm not saying that growth is not going to slow down. These Q1 numbers, of course, are backward looking. To